a changed Mitch McConnell and harkens back to all sorts of memories in the nation. Kayleigh mentioned on the break the senator from California having some of the same troubles, but I would take it back to Reagan and Bush Sr. In the history of here, someone like Michael Beschloss would go immediately back to Woodrow Wilson of how we adapt to quite elderly government officials.
Well, Tom, let's go through it. There are many upsetting aspects, dimensions of those pictures that we all saw in the last 24 hours. And first and foremost, our thoughts with the man himself, Mitch McConnell, and we hope he is well. Tom, the aide stepping in, I think that's what's concerning for a lot of people, beyond his health, because what it conveys. It is okay to be supported. You expect them to be supported, Tom, by the aides around them, not led by them. And when you put these pictures together with what we saw from Dianne Feinstein, the Democrat, in a similar situation, Tom, who didn't appear to realize where she was or what she was doing and needed to be led by an aide to vote. Yeah. Now, these individuals are elected to lead, Tom. We don't elect the aides around them to lead them on our behalf. That's not what this democracy is all about. Yeah, I think not just in the United States, but elsewhere too. So increasingly seeing those pictures, I think that's why it's deeply problematic, Tom.
I'm going to suggest through all of our history, there's always been one fossil to be light about it in the Congress, in Capitol, in the Senate, in the House, or 2, 3, 4. Quincy Adams was quite elderly at the end, but now it's the number of people we're talking about, including the analysis of the present president and the past president. It's not just 1 or 2 people now. It's a whole set of people who are saying, why are you sticking around?
Well, the conversation's happening, Tom. Term limits, age limits. I'm uncomfortable with saying that once you get to a certain age, Tom, you don't have the mental acuity to lead. I'm uncomfortable with that. One man at 80 is completely different to another. And Tom, I think it's going to be very difficult to deal with this as a country, but it's seemingly something that we've all got to face and got to deal with, given what's happening in America at the moment.
And just in the last 24 hours, Nicole Nerea and Karen Lamon over at Vox, I mean, yes, they speak to the senators' challenges, but they also have 6, 7, 8 paragraphs of the plot, if you will, on Capitol Hill. Gracefully, we address this issue with Anne-Marie Horton, our Bloomberg Washington correspondent. Anne-Marie, your thoughts yesterday as we observe this really difficult video?
It's very challenging to watch. It's very uncomfortable, and you feel for Mitch McConnell in this moment. He's being asked about whether or not he will seek re-election, and for 30 seconds, even longer than we saw him pause in this incident we saw just last month in July on Capitol Hill. Yesterday he was in Kentucky. He could not answer, and aides, as Jonathan said, had to step in. So obviously we wish Senator McConnell well. His team came out and said he had got lightheaded, seemed to take a pause, and he would see a doctor before his next event. But obviously there's growing concerns now, given that this happens so frequently from the last incident. And of course, when you have concerns like that, there's obviously to be, you know, some murmuring around Capitol Hill about who would take his position. You know, Rick Scott, senator from Florida, who actually challenged Mitch McConnell for this leadership contest last year, was asked about this on CBS, and he said he sees that Mitch McConnell will lead them through the remainder of this session, and then potentially there'll be someone, you know, he'll just have to wait. They'll all have to wait until the next leadership contest.
Anne-Marie, his wife, Mitch McConnell's wife, Elaine Chao, has been hugely supportive of what I've done at Bloomberg with all of her service to the Republican Party and to the nation. People like you in the Beltway, do you try to observe what the families are doing and advising in these difficult times?
Well, it was just about a year ago I actually sat down with Elaine Chao, incredible woman in terms of her, you know, rise to the top on boards, number of administrations, not obviously just the prior administration, but she's worked throughout Republican administrations. And sometimes people don't know that she's actually married to leader Mitch McConnell. But in this moment, you know, you're not going to hear a lot from the family. The staff is really going to want to deal with this, and they're not really going to say a lot. You're going to see the press release that we got yesterday and the emails and text messages we got yesterday, which is that this was just a blip. You know, we'll make sure everything's okay. But he's been, you know, they say he's been fine out and about at events, speaking engagements, and that's the most you're going to see. But you're not going to see a lot of individuals want to talk about this that are very close to him. They're going to want to make sure that they're just doing this from the staff press releases, and that's about it. And a lot of people are going to come to his defense.
Well, this isn't just, as John was alluding to earlier, Anne-Marie, about Mitch McConnell. This is about the age of a number of powerful individuals in Washington, be it Senator Dianne Feinstein, who, of course, was absent from the Senate for an extended period after dealing with shingles and has had difficulties since she returned, but also the man sitting in the Oval Office, President Biden, who also is in his 80s. He's an octogenarian as well. And we know that voters are starting to have more of a problem with age.
Yeah, they are. I mean, the recent AP NORC poll this week, I think, really highlights this conversation, which is that the majority of Americans, even the majority of Democrats, think Biden is too old. Now, the Democrats say they will vote for him regardless, but they do think he's too old to have another 4 years. And then, interesting, also in that poll, the majority of Americans, we're talking 65, 67, 68%, thinks there needs to be a retirement age for Supreme Court justices and thinks there needs to be term limits on those seeking elected office, whether the House or the Senate, as well as the presidential. So this is something that is going to continuously come up. Nikki Haley, the former UN ambassador, obviously GOP hopeful for the presidential candidacy, the nominee, she has said there should be mental acuity tests of those over the age of 75. The issue is when you start talking about maybe making this legislation, this is a very old Congress.
Yeah.
Do they really want to vote on legislation that could potentially see those in their 50s or 60s not be able to have the career they potentially want?
Emery, to segue here in a clumsy way from these true difficulties that bring the nation together is bringing the nation apart, and that's people that believe Donald Trump or not. Were you surprised at the bombshell revaluation of real estate that we heard from a court yesterday on the net worth of the former president?
I'm not sure if I'm surprised by all of this we see with the former president, given just the slew of legal battles he's facing, and this one being the latest. I was a little bit intrigued about the deposition and the transcript we have from that deposition, where he talked actually more about his time in office. He said that he didn't really know what was going on with the company business, didn't really have time or chance to look at it during his time in office. He wasn't running the company because he said he was saving millions of people, and talked about nuclear discussions he had with North Korea, saving America from a nuclear war. Very interesting stuff if you look at really the back and forth of the transcript, and almost seemed as though the president was personally insulted that the New York Attorney General said he inflated his assets, and he said those assets are, best in the world.
By $2.2 billion, Tom. Not just by a little bit, by $2.2 billion.
Well, we're advantaged here at Bloomberg with Tim O'Brien, who long before we had a presidential candidate was reviewing the finances of the Trump family and of Donald Trump. And I look forward on Bloomberg Opinion to seeing what Mr. O'Brien writes about this reveal. I've had some off-the-record conversations with Tim where he's clearly borderline encyclopedic on each and every tower. And I'm really looking forward to what Tim O'Brien says.
I'm pleased someone is, because we're not.
We're not, and I
That's
just, afterthought skated on his ice rink in Central Park that he wrote the check on. That's all I know.
Deborah Cunningham is coming up a little bit later from Federated Hermes on this equity market. 4-day winning streak on the S&P could well become 5. A special thanks to AMH down in Washington. Live from New York City, this is Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
To the kabaddi tournaments in India.
to the cornhole boards at your local tailgate. This is what's next in sports.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
Equities up just a little bit on the S&P by 0.1%. No drama here. Going into jobless claims 1 hour from now, just 60 minutes away. Claims and then on to payrolls on Friday. Equities totally unchanged on the NASDAQ. For all the drama, for a month of losses, in a month of August, Tom, we're down to 1.6%.
All the drama.
It's really not much.
For those older, we're always scarred by August of 1998, which is just a few years ago. It seems like yesterday, but there is this angst about August, and quite frankly, John, about September as well. And it's sort of as silly as sell in May and go away, or like last year, sell in October and go away. I mean, these calendar cliches get you into trouble.
The angst has eased off the back of this move in the bond market, and I think we should talk about ranges, where we have been and where we are.
Range is the right word.
Let's get to the bond market. 2-year, 10-year, 30-year. Just slice up the yield curve through those three maturities. The 2-year at 486.50. So the 2-year, the high of the week was 5.1%. So we've had a massive move lower off the back of job openings, which came in much lower than anticipated. Quits rate lower as well. ADP, whatever that's worth, downside surprise, just encouraging the move even further. So the 2 years had a big range over the last week. And the 10-year as well. A few Tuesdays ago, 436. And right now, a 10-year, a break of 4.1%, Tom, and down another 2 basis points on the day.
And what's important about this is those yields, John, take away inflation, and you've got some form of constructive, positive real yield. That's not the case in Europe. That's the stark difference as we go to September.
Let's turn to the euro just briefly. Lots to talk about for the euro. The data very much in focus. The euro against the dollar right now. Euro dollar 108.66, negative 0.5% going into the ECB meeting on September 14th. Under surveillance this morning, pressure not letting up for the ECB's rate decision a few weeks away. Eurozone inflation coming in at 5.3%, slightly above the 5.1% estimate year over year. Meanwhile, over in China, manufacturing picking up slightly, with the latest PMI coming just under the key 50 level. And in many ways, Tom, for Europe, those two stories are linked. What happens in China is going to shape things in Europe.
And the reaffirmation from Georgieva, as we talked to her at Jackson Hole, the managing director of the IMF, looking at a 5-year vision of global growth, which, you know, I mean, we're just 8 months into their historic call, but the answer is we're certainly seeing tepid global growth as the IMF was nudging towards.
What will the ECB do in a few weeks' time? I've got absolutely no idea. Isabel Schnabel of the executive board, non-committal. President Lagarde going into the next meeting, non-committal. The account of the last meeting, Kaylee, any clues in that?
Preference was initially expressed for not hiking, though eventually all members supported the 25 basis point rate increase. Does that mean maybe there would be a preference for not hiking in September? Can any of us really tell by what they're saying?
The fact that Lagarde didn't offer anything at all, Tom, nothing whatsoever in Jackson Hole, just tells you, I don't think they know where they're going to go in a few weeks' time. In fact, the Hawks may hold the key to what they're going to do. Even they sound non-committal.
Yes,
Even they sound non-committal. They're talking about maybe doing some more in the future, but certainly not saying in September I'm going to march into the room and demand a 25 basis point hike.
Yeah, there's a greater complexity there, nonetheless, because of the war in Ukraine. But Jackson Hole, the polarity, John, between Germany and Portugal, just as one example of the complexities, and that's different than, say, Netherlands, United Kingdom. The United Kingdom away from this, quite frankly, is part of the debate.
I bring this up because we have got some Fed speak to talk about away from the ECB talk. Raphael Bostic does not have a vote, but he continues to side with the Doves, warning to be maybe a little bit more careful about what happens next, Katie Lyons. Let's get to the quote. Based on current dynamics in the macroeconomy, I feel policy is appropriately restrictive. I think we should be cautious and patient and let the restrictive policy continue to influence the economy, lest we risk tightening too much and inflicting unnecessary economic pain. The latest Fed speak there. I want to finish on this. Dollar General shares tumbling after the company cut its 2024 net sales and profit forecast. That stock is down by 16%, Katie. Absolutely hammered.
Yeah, and they're talking about in the quarter they just reported how the decrease in gross profit was attributable to lower inventory markups and increased shrink, a word Tom does not like, markdowns and inventory damages. But I think you asked a really important question earlier on in the show. What is it that retailers are actually signaling about the health of the U.S. consumer?
They're not alone, Tom. Dollar General, in fact, even the likes of Walmart and Target were talking up potentially a softer quarter given the student loan resumptions. Yeah. A warning potentially for retail in America.
New and sudden rollover for Dollar General, 10-year track record, 12.3% per year total return. Pretty good for making $1 purchases there. This is an extremely well-timed conversation that we have right now. Coming up in 15 minutes, Max Verstappen, but more importantly, Deborah Cunningham joins us, Global Liquidity Markets CIO at Federated Hermes, and truly owns a high ground on short-term paper. I'm going to go through the math on this because a lot of people have asked about the new ETF we've got coming out next year, Deborah. But on the triple leveraged all cash fund, I got a 5.43% three-month T-bill. I'm leveraging that up 3 times. I'm popping 16.29% gross return, and then I take out my 2% fee and my 20% overage. Okay, that's an esoteric thing. The simple thing is people are addicted to the 5.43% in your world. How long is that 3-month T-bill yield going to last?
You know, Tom, we think it's lasting longer than maybe the market expects. Even though you see Fed speak like Bostic, and even to some degree, Chair Powell at Jackson Hole last week, trying to temper back people's expectations from a standpoint of further increases. Maybe this September meeting is a skip, not a pause. Maybe we go again in November. But in any case, I think the 5.43 and where we are generally in short-term rates stays with us through the end of this year. It stays into the beginning of next year. Right now, I think Fed speak should be, focusing on trying to take people's expectations away from the next cuts. They're not coming soon. That above 5 is there for a while.
Deborah, you and Federated on the high ground on this. What is the financial effect of, dare I say, trillions going to money market funds? What's the so what if everybody piles in to 5.43%?
It's a huge positive. You were talking earlier about student loan resumption. Well, what you can get from a standpoint of earning 5.43% now on your cash helps with the payments that are now due on, the amounts in student debt and other payments that have escalated from a mortgage, from an auto loan standpoint. All those things have gone up. But if you're earning more, if you're at 5% rather than 0, we were at 0.5 for a very long time. You're better off from a net worth standpoint and being able to pay that extra that's required for your liabilities.
Deborah, Kaylee was just going through the accounts of the last ECB meeting. Let's turn to that. Concern was raised that the economy might be facing stagflation. Is that your base case for the Eurozone economy?
It isn't. Probably if we looked at the Eurozone, Asia, the UK, and the US, we'd pick the Eurozone as the highest potential for that. But we still feel like there's enough, positive momentum in many of the countries to keep stagflation, keep rates above, where the inflationary rate is. Yes, you've got some counters to that from an energy standpoint, still supply side issues, supply chain issues in the European economy, but it's not our base case for that for that area.
Let's just go one step further. Let's say we do get that. Deborah, I mentioned this yesterday. I'd love your input on the subject. How do bonds trade in a stagflationary world? What would that look like?
Well, you're looking at something that, is basically probably on par, if not less than what's happening from a stagflation or an inflationary rate. And as such, you're probably losing in the process of your investing, or at least in the cash portion of it. And, I think people still at that point take the high ground. They take the, less risky, maybe you're not getting enough of a return in those asset classes to beat what's happening from the stagflationary environment, but at least you're not losing too much in the process either.
Deborah, to pull a direct quote from the minutes, after they raised the concern about stagflation, the minutes say, in view of the prevailing uncertainties and the large costs of bringing inflation down once it had become entrenched, it was argued that it was preferable to tighten monetary policy further than to not tighten it enough. Granted, this is from July 27th. There's no telling that the preference would still be for over-tightening rather than under-tightening in September for either the ECB or the Federal Reserve. But when are we going to know if they actually already did over-tighten?
Well, there's lead time to everything that happens. So I think it's, month to month to month. There's, and certainly no central bank in the world, to include the ECB, to include the Fed, wants to have a jagged line, up, down, up, down. They're not that responsive. They like to go in a trend on, toward one level, stay there for a while, and then maybe reverse course, but not reversing course multiple times in a year, unless there's something that warrants it that's, sort of out of the in the extraordinary type of picture at that point. But I think that you've got probably, with most countries' tightening cycles, you've got at least a 6-month lead time. So we're not going to know this information for whether they've tightened too much now until 2024.
Deborah, we don't do forecasts here. We do best guesses. Can we do best guesses for next month? ECB and the Federal Reserve. You expecting action from one and not the other?
No, I think they both are in a skip mode at this meeting.
Okay, Deborah, thank you. Deborah Cunningham there.
Phenomenal.
Of Federated Hermes. Just one of the best. Great to
They
catch up with
get
her as
no
always.
love. I mean, Deborah gets absolutely no love. Steve Othrock's in the room.
Was that not enough love? Was that
no, we give her.
enough
We're
love?
the only ones that give her love. That's the only reason she comes on. But short-term paper, it's not sexy. It's like, for 13-month CD.
It gives you something now.
3-month T-bill, whatever. Finally, they're back in conversation, and they still don't get love. Versus, should I buy the Austrian T-bill of 97 years?
Is that sexy?
That's
Is
sexy.
that sexy?
Oh, yeah.
I think
when you lose as much money as I've lost on the Austrian, way sexy.
The Nvidias of this world might be,
or the
sexy.
Huawei's.
The Huawei's.
Right.
Huawei's.
I got Tanya Chen in Hong Kong.
Huawei.
Said, Tom, you're mispronouncing it.
We're doing it right now?
I don't know. I can't remember.
Huawei. I think we are.
She was
those ECB minutes, accounts, whatever the ECB likes to call them. Kelly, fascinating.
Yeah.
Fascinating. How does that guide your thoughts shape your thoughts into the meeting next month?
Well, given that these are backward looking, I don't know, but the thing is, what they're talking about has only perhaps become even more evident. Still in elevated inflation outlook. We got more evidence of that in the data this morning, 5.3% on the headline year-over-year figures. And yet you also are seeing some of the growth deterioration still showing up. So do they have any more clarity going into this next meeting than they had on that story back in July?
Their minutes, whatever they're called, are sanitized, right? I mean, what are they really talking about?
Well, they're far more sanitized than
the
Fed minutes are, yeah.
What are they
ECB
talking
accounts.
about?
Tom, it gives me the impression this really is a game time decision for the ECB in that 2-day meeting.
Yeah, and
like truly a live meeting, getting around the table and figuring this out.
Lagarde in a New York speech made very clear it's a jumbled system.
If you are just tuning in, welcome to the program. Equities elevated here by 0.2%, potentially heading towards a 5th day of gains. 2 teasers, a tease, Tom. One with Andrew Hollenhorst, who is the best guest in the next hour. City at 8:30, or this guy right here, Max Verstappen of Red Bull Racing, coming up next on Bloomberg TV and radio.
Yeah, John's going to drive the interview because he's the only one who knows what he's talking about. I've been reading the literature on this, and to me, it's like sort of like the horse and horse racing. Everybody says, well, it's the car. And if Checo starts in 14th position and gets up to 7th position, it's the car. Or if Max is in 2nd or 3rd and wins, as he always does, It's the car. That's what I want to explore to them. I don't buy it.
It's Max.
Yeah.
The dominance of Max Verstappen. Tom, if you put Max next to anybody right now in that car, Max is winning. And the best way of judging this is judge him against his teammate. And there's a massive gap at the moment. It has been all season for most of the season.
Can we remind ourselves this kid is 25?
I know.
He's been doing it since he was 15. He won his first race in the big time at 17.
As far as I understand it, he did a year in Formula One before he actually got his driving
I think
license.
he's only coming on because he's interested in the triple leveraged all cash fund.
Should we talk to him about the bond market?
Should.
Let's not
what's
do
he
that.
doing with his money?
I hate that stuff. I don't like asking athletes about investing money. That is
You're
just against the rules on this program.
Yeah, we don't do it. I mean, we're not,
Max Verstappen, Red Bull Racing.
Thanks for your comments.
Coming up next.
So let's go inside the boardroom. Let's suppose you win a proxy fight and/or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present it with a plan.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready? Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg. Top experts. Great questions.
Let's get you up to speed on the price action just briefly and start with the S&P 500. Equities here positive by 0.3% on the S&P. 4-day winning streak on the S&P, the longest winning streak back to mid-July. We are on course to make it 5 on the S&P 500. That winning streak trimming the month-to-date loss to 1.6%. That would make it the first monthly loss since February, which tells you a lot about the year so far. A year of double-digit gains on the S&P 500 and on the NASDAQ too. The NASDAQ, by the way, heading towards a second week of gains. In the bond market, Treasury shaping up as follows. The 10-year yield at 4.0925%, down a couple of basis points. The 10-year a couple of Tuesdays ago, last week, 4.36. Yields have dropped all the way in from there to a low of about 4.08% yesterday. The range on the 2-year this week alone, wide, 5.1% at the high. The 2-year this morning dropping into the 480s at 486 and down a couple of basis points. So that's the bond market. Let's finish on foreign exchange. The euro at 108.65, negative by 0.5%. That is a weaker euro. Inflation all week, whether it is Italy, Spain, or Germany, it has been upside surprise for the Eurozone inflation story. With CPI coming in hot, there is a question about whether the ECB makes a move in a couple of weeks' time on September 14th. There was some reluctance to make a move, Tom, around that table last time around at the Governing Council. You wonder if that reluctance carries over into the meeting on the 14th.
That's going to be sport as well. And again, as you said earlier, John, I think it's really, really data dependent. But, on Labor Day, which is sort of like New Year's for the business community, get the kids back in school and begin out into September as well. And John, I'm just going to point out that from the Ralph Ancapora Ed Yardeni low, I'm up 24% from the October low, Standard & Poor's 500. I mean, I know the S&P is not performing. It's only Apple.
Just learning that Max is a little busy, Tom. He's going to be delayed 10 minutes. So
okay, well,
Max is going to be late about 10 minutes. We're still going to make this conversation happy. He's got things to do this weekend, I'm told. There's a race in Monza.
Well, he's busy. You know, he's like busy.
Taking his time getting to the camera.
You know what he's got? Let's take a moment here. When you look at their car with all the stickers on it, or their uniforms,
all the sponsorship,
the sponsorships. If he spends 15 minutes with each sponsor, that's why he's 10 minutes late to Bloomberg surveillance.
Because he's got to do the circuit.
Yeah, he's probably, or he's having a Red Bull. Could be.
Do you think he drinks that stuff?
I don't know.
You should ask him.
They do in their victory. Do you think they drink the champagne? I mean, the guy's like coated in champagne 24/7.
Yeah, I wonder what that is. Yeah. You can ask him that too. There's two questions.
Somebody dropped the trophy a couple days ago.
I saw that. That's been remade apparently.
Yeah.
Hungary. They've remade that.
We hope that Max Verstappen will join us here right now. We had to go find somebody to follow up with after Max Verstappen is 10 minutes late, and never late is Michael McKee, Bloomberg Economics and Policy correspondent. You were standing to the side as I was warbling gaily with Christine Lagarde. She's not Jay Powell. What's the number one difference that she has in the day-to-day grind of central banking versus what the American central banker has?
She has 19 different countries to worry about, whereas the Fed chairman has only one. So monetary policy making is a little bit more difficult in the sense that there are differences between the various economies. You get something like Croatia growing 3% this year, something like Germany growing 0% or a little bit less. And so the impact of raising rates is different on different countries, and so they will have different views. And she's got to make everybody get together and come up with a consensus on what to do.
Well, when you look at the account, Mike, and I read this line earlier, but it was argued that it was preferable to tighten monetary policy further than to not tighten it enough. And this is a conversation we hear at the Federal Reserve as well. Loretta Mester, for example, leaning more toward over-tightening than under-tightening. Raphael Bostic, though, just earlier today, suggested the opposite. Do we have really any idea what the preference would be, which way they would lean at this point?
Well, the majority say they would rather over-tighten than under-tighten. They don't want to send the economy into recession, but if we start to see a real deterioration in the economy, they can cut rates. What they don't want to see is inflation go back up again, and so they're going to lean in the direction of higher rates. Now, we're within 25 basis points probably of any kind of peak, so does it really matter all that much? Not a huge amount. It's more of a signal than anything else at this point.
Does the data this morning that we have yet to get really matter all that much? Jobless claims, spending, PCE deflator?
Well, the PCE numbers are going to matter because that's the gauge the Fed follows for inflation. Particularly, Jay Powell's been looking at the so-called supercore, when you take core services ex housing, and Raphael Bostic was making the point this morning that if you do that, if you take out housing, then you have your core running about 2.9%. So you're getting into the area
handles, right,
of what you want to see.
I want to go to the great unspoken, which is this theme that the savings, the fiscal stimulus of the pandemic is worn out. Is this right, Mike, that you can calculate today the quote unquote savings rate of Americans?
Well, you can calculate the savings rate, yes, and we look at that as some sort of measure of whether or not people are still have enough money to keep spending
what are we doing
without going to credit cards.
I mean, the haves are saving; they're doing 401ks and all that. 2/3 of the nation's not savings, right?
Well, it's weird because 401ks aren't counted because the money comes out of your paycheck. They're looking at the net money that you have left over after taxes, and they subtract what you spend, and that's the residual that they call the savings rate. So it is a little bit odd, but people aren't going to be spending their 401ks anyway on regular goods. So it's the best proxy we have on a easy to figure out basis, and it has come down to about 4.1%, but we don't know if Americans are spent out yet.
Thank you.
They keep spending.
Thank you.
We keep hearing the same thing over the last year, that this is the quarter, and now we're told this is the quarter. Mike, do house prices matter when they're so distorted by this Federal Reserve?
Well, the change in house prices matters. That's the issue for the Fed. Is when housing prices go up, it adds to CPI and PCE inflation on a percentage basis. But remember, it takes about a year to get into the data. So house prices are going up now because things are distorted, but they went down. And so what we should start seeing is declining housing prices, a declining effort, a weakening of inflation based on that.
So further progress, potentially. This came up at Jackson Hole. It's worth talking about for the rest of this year.
That was a great, you asked the question, and it was a great question of Pat Harker.
You never say that to me.
Because they're ready. Anyway. Mike, beyond that, going into next year, there is a feeling that we get down to 3, and then it gets really hard to get down to 2. This was something that dominated the conversation in Jackson Hole. The Fed chair says the target is 2. Then you ask the people around the meeting, is the target really 2? Are they willing to cause that pain in the labour market to go from 3 to 2? And you start to get pushback. What's your insight on that, your take on what's actually happening on the committee? Is there a tolerance there for above 2% inflation?
There's a tolerance, but an unspoken tolerance in the sense that it's going to take a long time probably to get that last mile from 3 to 2. And what they're going to do is leave rates. They won't raise rates, but they'll leave rates as long as they can high to see if they can bring it down to the 2% level, get into that area. There is a feeling that they can maybe do that. Then wait until 2025 when they review their monetary policy operations and then say, okay, we'll go to a 3% target or something like that. Because if the economy stays growing at a faster pace, then your neutral rate has risen and your target can rise.
But it's also about credibility too, right? The Fed can't be seen saying, all right, never mind, we can't get there, so we're changing our target.
Well, it's the same way, the same thing we see in Jay Powell's speeches and all their speeches when they refuse to use the R word. They talk about pain, they talk about less than trend growth, but they never say recession. They're never going to say recession because we know everybody at a trading desk will immediately hit sell the minute that word comes out of their mouth.
Mike McKee, just great work as always over in Jackson Hole. It's just great to watch Mike McKee work the room. TK. Get together. It's just fantastic.
You go into the $1 Million Cowboy Bar, and I'm over at the left bar. McKee's working the whole long right side bar. He's working the room.
Fed officials just surrounding him.
He's working the room
with a glass of water.
Raphael,
with a glass of water in my hands. We want to make sure management knows that.
This one, not a glass of water. Mike, thank you. Coming up in about 5 minutes' time, we'll discuss this market, wrap up August, look ahead to September and those key central bank meetings with Cameron Dawson of New Edge Wealth and Max Verstappen. Stand by, Tom. I'm told he's working his way towards the camera. We're going to make this happen with Red Bull Racing over in Monza for the race this weekend in Italy.
Very, very exciting, and a lot to talk to him about. And, I don't think we'll get to it. Zandvoort, the rain never stopped.
But have you seen the party? Did you see the party in the Netherlands? It rained, the race stopped, but the DJ kept going and everyone seemed to have a great time.
They did.
What's that about?
It's about Max. It's
all about Max.
Ferrari, Monza, that looks ugly.
That doesn't look good, eh? Doesn't look good at all.
Car Talk with Tom Keene.
Very good. From New York, this is Bloomberg.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television. our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
The Fed has achieved what they wanted to, at least thus far.
The Fed is likely to let past increases in policy do their work. They're likely to let the lags have their impact.
I think by the end of this year, you're going to see inflation with the 2 print.
There's no recession in sight because everything in the economy in the U.S. is really pretty well balanced.
I think the one area that's going to disappoint is jobs. I think there are going to be downward revisions.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. Not a sleepy August week. It is more than busy. Kaylee Lines in for Lisa Abramowitz. And in this hour, we will look at equities, bonds, currencies, commodities, and we will also look at what John Farrow calls the temple of speed. Monza this weekend. This is fun. Week after week, they take the road show from Zandvoort in the Netherlands down to near Milan, right?
This is Ferrari's home race. Top speed of more than 200 miles an hour, average speed of something like 150, 160.
Not many turns.
These guys are going fast, Tom. This is like one of the races on the calendar that I love to see.
Right.
Unfortunately for Ferrari fans, things aren't going so well going into this weekend.
Lots going on here, and we say good morning to all of you worldwide who just love Formula One. It's burgeoning. And what's Las Vegas? Are we going to Las Vegas?
If we can find tickets. Why don't you ask our next guest?
Okay, well,
we can get us
tickets. Maybe we can get us tickets as well. Who should we speak to? And as we've talked to Christian Horner and others of Formula One, there's always a desire to talk to the gentleman who truly dominates and owns the high ground. And John, as you bring in Mr. Verstappen, all I can say is this kid was in show. He was in the show. He was in the big time before he had his driver's license.
Amazing, isn't it?
Before he had his
Dominance
driver's license.
is the word. Max Verstappen of Red Bull Racing joins us right now. Max, good morning, buddy. It's great to catch up with you, sir. 9 wins in a row, just phenomenal. You're trying to make it 10 at Monza. How special would that be?
Yeah, I mean, of course, it's something that I never even, thought about that is even possible, right? But now that we have won 9 in a row, tying the record, of course, you want more. And I think we have a good opportunity, but F1 races are never straightforward. A lot of things that can happen. But yeah, I'm excited, of course, for the weekend.
Max, let's go back a couple of decades. Take me back to the days when you were in a go-kart and you got to be around people like Michael Schumacher and your father, for that matter, as well. Is that where this hunger, desire comes from to dominate, even after you get win after win?
Yeah, I think of course, you really wanted from a young age. But I think also the way I grew up, having the experience of my dad by my side, for sure, from a very young age, I think you get prepared in a different way, I guess. And for me, it's never good enough. Even you try to look for the little details that can go better. I mean, for sure, this year so far, I think has been amazing. But I will never be satisfied at the end of the day.
Max, Tom and I were talking about Marco van Basten retiring from football at 28. And I always hear people talk about you. They say things like, he's going to get bored. He's going to get bored by this or potentially step away. Do the records that Schumacher set, are they worth sticking around for you, Max? Is that something that drives you?
I never really targeted records. I, of course, really enjoy what I'm doing now. And I think for me at the moment is the opposite. This for me is not boring. This is really exciting. I'm always very motivated to get to the track. I think it's more when you're not winning anymore and there is also no real plan in place or a future where you see yourself winning again, then probably you get bored. But I think retiring at 28 for me is probably a bit too soon.
Max, John Farrow is steeped in all that you do. He grew up in England and lives Formula One. I'm your ugly American. I'm new to this. I'm the one you need at Las Vegas, you need at Austin, Miami, wherever. And in reading about this, and I go to the great journalist Peter Windsor on this, he says you do corners and turns like nobody. He talks of Silverstone and the 3 turns of Maggots and Beckett's. How do you approach the tight turns of Formula One? Peter Windsor says that's the difference.
I think everyone has their own driving style, but also I think what is key in our sport is that you're able to adapt to whatever is needed. So, every year we have a new car, a different looking car, and every single car drives a bit differently. And I think, you always have to adapt and learn and try to grow, try to be different, try to really, get the most out of the car. And if the car is driven the fastest way in a different way than what you're used to, you have to try and adjust to that.
Do you wish for a smaller, lighter car?
Of course, that would be ideal, but you also have to be realistic. I think with the safety standards that are, always improving every single year, that is not always possible to go lighter. But I'm sure, we are looking into the future regulations as well to try and make it better.
Max, your bosses are thinking about the commercial stuff. We caught up with Christian Horner. It's great to talk to Christian a month or so ago, and we were talking about the race calendar and how many races are now in new places, like in the United States, like in Vegas. For a man like yourself, can you compare, say, a Monza to a Miami, a Las Vegas? And Max, do you get excited about it when, for some people, the purists might complain about this just being a commercial event, moving away from the traditional race car racing in places like Monza and Silverstone?
Well, the beautiful thing is that we have a lot of different Grand Prix still, and I think it would be very boring if they're all the same, right? And yes, I am very aware that we shouldn't go to all the, let's say, the commercial places, but I think also Las Vegas gives you a unique opportunity, and then time will tell, if it's the right way to go or not. But for sure, from my side, I like the pure racetracks. I think in F1 car as well, it really comes alive on the proper racetracks like Monza, like Spa, like Silverstone. So for sure, we need to keep these kind of tracks on the calendar.
Max, they're always trying to rework the format when a team goes through a period of dominance. I remember when it just used to be qualifying 30 minutes. Fastest driver, fastest car, they get pole. Then they tried to make qualifying more interesting. Do you think tweaking the format with sprint racing in one weekend, not the other, is that something that frustrates you as a driver?
Yeah, I'm not really excited by these things because I think when something works really well, why do you need to try and tweak it? This is, I think, a constant discussion, and for sure, some things will work out well, some don't. But for me, trying to keep it like it is, probably is the best thing forward, because I always thought the qualifying format and before you get into the single race, I think is very exciting.
Max, I agree with you. I'm a complete hack at this, but I totally agree with you. The sprint thing is ridiculous. I just don't understand it. I love the qualification thing the day before. I love to tune into that. Max Verstappen, are you in a place is completely dominant in the sports involving all the money and the egos, where can you control the future of who your teammate is? I understand there's autosport gossip and all that, but are you in a position now, Max, where you can dictate, discuss, or say who a future teammate will be?
Well, this is always up to the bosses and the team. I mean, of course, I'm a team member now for a long time. And of course, things, you talk about stuff, but I'm not the one who is telling them what to do or deciding things at the end of the day. I need to focus on my job, and that's to try and drive as quick as I can every single weekend.
We do a good job of that, Max. A good job of that, particularly this season. Max, how close are you with Checo?
Yeah, we are very close. Honestly, I think we are very similar in a way also how we approach, I think, our life outside of Formula One. He's a real family person. Of course, he has his kids as well. I'm pretty similar. I think it's good to try and, sometimes switch off and just, not think about Formula One. And I think that's where we can really relate.
You know what people are like? They like to stir up gossip and tell stories. And Max, you've been reluctant to get involved in the Netflix series, which has been massive here stateside. Max, what's behind that reluctance? Why don't you like doing those things so much?
Yeah, I mean, I think at one point, certain things are also a bit more private. Privacy for me is very important. And, I like things to be portrayed like they actually are, not with a lot of, let's say, spice to it. But every year now, I mean, we had a good chat. Every year I do have an interview and I explain my side of the story, and I think that's important. Yeah. I know how important Netflix is in a way, of course, to try and attract new fans, but of course, it's important also to really see the reality of the sport.
John, I'll let you ask. I mean, we're in London, we come back, and that gives us just enough time to go to Las Vegas in November. But, if Max can pull some strings for us, I think possibly we could be all Las Vegas with Red Bull.
You want to ask him yourself? Or you want me to
I'd let you ask, please.
I think maybe Max would prefer us to ask Christian Horner, and we'll ask Christian a little bit later. Max, I wanted to squeeze this in. I wanted your side of the story. I don't want to talk about the last race. I want to go back to Austria. Final lap of the Grand Prix. You have the opportunity to set the fastest lap. You make the call to make a pit, to put on fresh tyres, and go around and set the fastest lap for a single point, Max. From your perspective, walk me through the thinking there. Is that something you've planned ahead of the race? Is that something you think about in the moment? And where does that confidence, that conviction come from? To go against a team who would like you to stay out and just make the call yourself. I can do it. I know I can do it. I've got the control, the ability to perform. Where does that come from, Max?
Yeah, I mean, I always try to maximize everything I can. And, I saw the opportunity for the extra points. So I was like, well, why not? Of course, there's always a bit of a risk with these kind of things. But on the other hand, no risk, no fun, right? So that's what was also going through my head at the time.
Max, good luck for race weekend during the team. Fantastic to catch up with you, sir. Max Verstappen of Red Bull Racing. TK, just one of the best right now. Absolutely dominant.
What were you doing at 25?
Not that.
I look at this, folks, and I really urge all of you, particularly in America, where this is all new to us, go to Wikipedia. It's a lengthy Wikipedia. And just see how this kid, as you mentioned, John, his father was the real deal, Formula One. His mother was involved in the sport. He straddled the Netherlands and Belgium in a divorce, and he just worked at it from day one, 7, 8 years old. You walk right through the triumph and some of the adversity along the way.
He was karting with Charles Leclerc as a kid. Some fantastic pictures of that. Who's with Ferrari right now. They've been around each other for years. There's some fantastic pictures of him with his father, Tom.
Well,
and as well with Michael Schumacher as well. One of, if not the best drivers to ever do it.
And his father's there in the pit. Like when they win, he's over, greeting his father as he greets the teammates as well. What I love about it is third place every single race is somebody new, like Pierre Gasly last week.
That's Tom, great. To that point, I think some people get bored of dominance sometimes. I don't. I admire it.
Yeah.
I want to understand what's behind it. We saw it with Hamilton and Mercedes. We saw it with Schumacher and Ferrari. And right now, I think we're seeing it on a completely different level with Red Bull and Max Verstappen.
It talks to Red Bull, and thanks to our team for putting this together with Mr. Horner.
More Formula One still to come, of course, through the race season. And hopefully we'll end up at Vegas if Horner follows
21
through.
23.
If you're just tuning in, welcome to the program. The S&P 500 right now positive by 0.2%. 0.2%. Coming up, 8:30 Eastern Time, Andrew Hollenhorst, the City, on their call for one more move from this Federal Reserve, Tom, before year end, and maybe the best guest of the hour, Cameron Dawson. Cameron around the table with us. Cameron heard me last hour, and I said, "Is it Andrew or is it Max?" And she's like, "I'm not talking to you."
Were you at Miami? Were you at Miami?
No.
Formula One?
No.
I could just see you down there. I mean, you see Cameron down here.
Miami, Vegas. I don't like the new race calendar. I don't. I'm just going to put that out there.
I do not like it because, to me, these courses are radically different. It's not like, Fenway Park versus Yankee Stadium. They're radically different. I loved at Zandvoort, the up and down.
That was cool,
We don't see the elevation thing. You don't have that at Miami. It looks like a boulevard.
I get that the owners of Formula One want to make it a circus. It's about providing content. I understand all the financial reasons for that. But if you're a racing purist, if you just want to see people like Max go around classic tracks like Silverstone, like Monza, and elsewhere, Tom, that's the part of the race calendar that I love.
Well, like Watkins Glen. In my ute, up in, upstate New York, there was Watkins Glen, which is sort of
just like Monza.
Those. Yeah.
Sort of like those. Just like it.
Did I do okay there?
That was wonderful.
I was up all night. I pulled an all-nighter to get ready.
Equities on the S&P 500, slightly positive. 16 minutes away. Jobless claims in America. Then on to payrolls tomorrow. The data so far making progress in a way that maybe the Fed would like to see. Equities up, yields lower. We're down 2 basis points from New York. Good morning.
London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
The 10-year Treasury, in my mind, is a screaming buy. I think that we do get 10-year yields back to 3%. I don't think it happens this year. I think that that will be a first half of 2024 event. I do think that there is a significant mismatch between the primary buyers of Treasuries and the incremental players.
How do we go back to talking about treasuries after that? But apparently we have to.
Because Max needs some laddered treasuries.
US rate strategy at BMO Capital Markets. We almost asked him about the treasury market. I just hate that stuff.
Max Verstappen,
I hate that stuff.
Are you taking advantage of tax-free bonds?
What do you think of the 2-year right now, 5%? Let's turn to that bond market and have a look, a sneak peek of what's developing going into jobless claims about 13 minutes from now. Yields are a little bit lower, down 2 basis points at 4.86 on a 10-year, 4.09%. That's a big change in the last week. In the equity market, slightly elevated positive after a 4-day winning streak, attempting to make it 5, up a third of 1%. And Katie, headline after headline from China in the last hour.
Yes, indeed. Now, we already knew that this might happen, but now confirmation. China has approved a rate cut on existing mortgages for first homes. In addition to that, the PBOC lowering down payments. for first and second-time home buyers, really trying to stoke the property market, which we know is struggling to a very large degree. Country Garden, just one example of that. But then you also had headlines earlier today, raising tax breaks for childcare. It's just one thing after another.
Can I ask the surveillance dumb question of the day? Doesn't the government, particularly given a totalitarian regime with unique control, just step in and bail them out?
The property sector?
Yeah.
If you listen to our team at Bloomberg Economics, it's too big to bail out.
I don't buy it. Again, they're China. They're huge. You know, what are they?
I will tell you off the back of this, we do have an FX move. If you bring up dollar CNH, got a stronger Chinese currency off the back of some of these measures. So slowly, it's just starting to pile up, Tom. Is it going to make a difference? TK, to your point, is it about ability or willingness? They have the ability.
Willingness, absolutely.
About willingness.
100%. And Jay Pulaski was brilliant on this one. He wasn't talking about Duke football. Kaylee almost walked
He
off
emailed
the
me
set.
about that a bit
Kaylee
ago.
almost walked off the set. I mean, you know, it's painful. What a day it has been. We're going to migrate to this, and she has been more than patient. Cameron Dawson joining us, CIO at Red Bull Formula One Racing, joins us this morning. Thank you so much for your patience with Max Verstappen. Greatly appreciate it. You've got one single sentence, and you go right to the heart of it. September is the worst month, and yet you're hardwired optimistic you got to be in the market. Do you go to cash in September?
No, because September being the worst month is just because it's below average returns. It's not necessarily that it's all going to implode. And even the correction that we had in August was below average, meaning it was so small in its magnitude. So it doesn't really warrant making big portfolio changes. I think at the end of the day, this correction has not been about growth. And in fact, we've actually seen EPS growth estimates going up in recent weeks. And I think that's one of the reasons for these shorter, shallow corrections. It's when the revision cycle turns down that you should be more concerned of a deeper correction.
Ian Lingen, BMO, moments ago, we just played the clip. He said screaming buy, 10-year. It's actually my words that I put in his mouth, but he agreed with it. Do you agree it's a screaming buy?
Well, if the 10 years is screaming buy, then credit is a screaming sell, and equities, at least the riskiest parts of equities, would be a screaming sell. Because we think that for the 10-year to go back to 3%, you would actually have to see much weaker economic environment. You'd need to see the whites of the eyes of a recession, and that likely means then that those economic or those earning projections for 2024, which have about low double-digit growth, are way too high. So if the 10-year goes back to 3%, we think it would be bad for risk assets.
Do you see that recession?
Not
the whites of the eyes?
No, not yet. Though, there's all this discussion about GDP versus GDI and if GDP will catch down and really what is the underlying growth rate. But for right now, we don't see enough evidence that a recession is imminent. And there still are calls that we'll enter one in the fourth quarter. We think if we do have one, it's much more of a 2024 scenario, which just means that it's not being priced in yet.
If we don't have one, though, couldn't that also be bad news if the landing is too soft? Couldn't that mean the Fed has to do more and then eventually has to force it anyway?
Yeah, it is very peculiar because that is actually what's happened in 2023. The Fed has had to do more than what was projected. Yeah. The bond market has had to price in more hikes, less cuts. You've seen yields go up. Yields the pricing of the December 2023 Fed rate has gone up 170 basis points since the March low. Since that time, the NASDAQ PE multiple is up 36%. So I don't know going forward if the path of the Fed matters as much for equity valuations as it did, let's say, in 21 or 22.
We talked a few days ago about the cost of real estate, renting, the struggle for a huge body of America to find a down payment for real estate. We got a huge response on that discussion. Do you advocate margin here within this bull market? This question doesn't come up enough, I think. Everybody's out there selling the idea of leverage up margin, options margin, futures margin, margin. Do you advocate using margin within the growth sphere?
Well, margin is a heck of a lot more expensive than it was just a few years ago, given rates are higher. So you have to factor that into the equation. We have seen, you can see measures in FINRA data about the usage of margin debt, and that's come off of the 2020 win peaks, which is not surprising. But the real question is how much of that is being replaced by options, which are a form of margin.
4 to 1, yeah, roughly.
And so you've seen so much option activity, surging call options, those 0 date to expiration options. So margin is always always something that you have to play with very, very carefully because it, of course, can work against you very quickly.
She memorized it.
Sometimes that can go bad.
Cameron just nailed that.
Can we talk about a different kind of margin, profit margins? At Dollar General, they've come out and basically said earnings are going to tumble as much as 34% on a per share basis during the current fiscal year. It's pretty brutal stuff. They're not alone. Are you taking what the retailers are saying seriously? Is this more important than what the hard data is telling us right now, which is retail consumption is better than good?
Well, there's some retailers that have pricing power and some that don't. And I think that Dollar General probably falls into that category where the elasticity of the demand of their customers is much different than the higher end retail where they can continue to push price. They can continue to pass on those higher costs to their customers. So the areas where you don't have pricing power is where you're seeing the margin pressure.
Yeah, and of course, when we're talking about the different areas within discretionary and pricing power, travel, airlines, they've been able to exercise pricing power in such a material way as we've seen demand recover out of the pandemic. And John, you earlier this week pointed to when we got the consumer confidence data, which was weaker, people were still willing to travel.
Planning vacations.
Put it on their credit card.
Now, I don't know whether to believe that data or not. I'm wondering whether they just saw Instagram posts and were like, I'm planning one too.
Right.
Like, I wonder how that data's put together. Are we going to see that vacation boom continue?
Yeah, the FOMO is real, and there's all this talk about all of the summer that we've had with the concerts, the hot girl summer, if that's coming to an end. I think at the end of the day, the question going forward is, can the consumer continue to live beyond means? We've seen credit usage go up, but it's that savings rate that's coming down and the savings balance that has been whittled down.
Did you see how a chill just came into our offices here at 7:31? I saw Hollenhorst walk by.
Andrew's
and it's
in.
like the black cloud of high interest rates.
I can't even see because the lights aren't on in the corner of the studio, so I can never see.
The room when Hollenhorst shows up. If we get an Andrew Hollenhorst world of higher interest rates, what does that do to your stock portfolio?
Well, I think it does increasingly create a challenge, but as we just talked about, is that we have seen this divergence of yields and growth valuations, for example. In the past, we would say that if yields continue to climb higher, we should be concerned that growth valuations trading up near 2021 highs would not be sustainable. Now, if yields are higher because growth is better, inflation's higher, that is good for the earnings side of the scenario, but then you get that offset from valuation.
The Eras Tour has been the most meaningful electric experience of my life so far, and I'm overjoyed to tell you that it'll be coming to the big screen soon. Starting October 13th, you'll be able to experience the concert film in theaters, Tom, in North America. Do you like that?
This is Taylor Swift speaking, not John
Do
Farrell.
I need
definitely not me. That is a direct
Do
quote.
I need a friendship bracelet? What's a friendship bracelet?
Isn't that something you tie up and hand to a friend?
Have you seen this, Cameron? Have you seen Miss Swift?
To buy them on beaches.
No, I have
We're
not.
looking at Paris tickets. Paris tickets in May of next year. A decent seat's $900, and somewhere back near Lyon is $700.
It's a bargain.
Cameron, thank you. Cameron Dawson of New Edge. Coming up in the next hour on Bloomberg TV, Daryl Cronk of Wells Fargo, the Chief Investment Officer, will catch up with Joanne Feeney of Advisors Capital Management, Jack Caffrey of JP Morgan.
If she pays that much to the IRS, do we get to pay less taxes? I guess.
If only it worked that way, TK.
It did.
If only it did. Maybe that's a good idea for
I'm
the
watching
campaign
the
next
video
year.
here.
What
Coming
video
to
is
theaters.
it? Okay.
She's doing Barbie, except it's not Barbie, it's Taylor.
Get the popcorn
Eras
ready.
Tour goes to the movies. Okay. From New York, this is Bloomberg.
the EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. It is then the market forces and the business incentives of global companies that transform that EU rule.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Bloomberg surveillance on the break. Kaylee Lines trying to book Milan, Emirates Air, nonstop Milan to go see Monza.
Yep.
You and Max.
Totally.
I mean, there it is. It's a big deal. Thank you to our team again for a conversation with Max Verstappen. We're trying to get back on keel here, and we can do this with Michael McKee because it's RAF, the Seattle slew of data today. Personal income and spending is what I'm looking at. Launching our data here. It's slow to come out on a pre-Labor Day. Michael McKee, is the wheels turn in Washington to tell us what's going on in America?
Yeah, just barely getting some data. Here we go. Let's start with jobless claims since it's at the top of our list. 228,000. That's down from 230 the week before. That's the unrevised number. I'll see if I get that for you, the revised number. Continuing claims rise to 1,725,000 from 1,702, which is not a big deal. It does still suggest that the labor market is fairly tight. We're not letting people go. Personal income up 0.2. That is less than the 0.3 the prior month. And personal spending is up 0.8, which is not only higher than it was last month in June, 0.5. It is higher than the estimate of 0.7. So you've got the folks at the Atlanta Fed on their GDP now doing some quick recalculations. PCE's deflator. These are the Fed's favorite inflation numbers. At this point, up 0.2 during the month of July. And so on a year-over-year basis, it's up 3.3%, which was exactly as forecast, higher than the 3.0. This is base effects that are happening. The fact, guys, that it is 0.2 is basically what the Fed wants to see. We're not seeing an acceleration in inflation anymore. Same with the core, 0.2, and it's up 4.2%, which is also bang on expectations.
Michael McKee, what else do you see here? I got the market lifting up here. I mean, it's been a 4-day lift. I don't know if I can describe it. The data Dow futures up 195. The VIX comes in 13.75. What does this do to Atlanta GDP now? Are we going to get away from this 5+X near 6%?
Well, not with these numbers, because the personal consumption numbers are higher. So you would expect them to still be in the high 5s. Maybe it tips it over into 6. I don't know what their weighting is for this. Obviously, everybody expects that to go down as the third quarter progresses, because this is only the first month. The revised jobless claims for last week were 232, up from 230. This is the funny thing about jobless claims. It's like the training wheels of economic indicators, but you can never make a great prediction because they always revise the previous numbers, so you don't know what's going on. But what it does show you is that claims went down significantly from the prior week.
Translate that. That means it's a better labor economy than the gloom that's out there, right?
Well, I don't know that there's any gloom out there. Everybody's still looking at a fairly tight labor market. We are seeing a deceleration in job creation as jobs get filled, but we're not seeing a rise in unemployment.
Never a dull moment. Michael McKee here with a serious set of data today, including at 9:45, the Chicago PMI, maybe obscure, but he'll make it important. And then on to jobs tomorrow. That will be fascinating. We'll go beneath the headline data. Kayla Lines will not be here. Lisa Abramowitz will not be here.
And Jonathan Farrow?
Jonathan Farrow. He's on his way to Monza. He will not be here.
I was thinking about asking for the day off.
Crypto jobs report.
Let Tom handle it all himself.
Well, that's what I thought, and they said you can't do that. So Kay Greifeld will show up, and we'll have a crypto jobs day.
There you go.
Oh, okay.
Looking forward to that.
There we go.
Ms. Greifeld will be with us tomorrow. Right now, we're going to migrate to the conversation today on economics. No, it's not with the economist Max Vanderstappen. It's with Andrew Hollenhorst of Citigroup, who joins us right now. Hugely interesting, and a lot of talk at Jackson Hole about the Hollenhorst conviction. I want to give you a little history on this. There is a character and culture to each school. And the character of culture of mid-20th century UCLA economics was one of courage. It was an entrenched faculty pushing against the freshwater economists, pushing against those liberals up in New England as they are. They were different out at UCLA. And there was a guy who died at 88 last year, Axel Leonivud, who was a hero in my house. And as someone once said to me, he was the Marine coming out of the trenches. Andrew Hollenhorst has been the Marine in this odd Fed cycle. You have taken shrapnel for your high yield call. People are like, not. And yet you reaffirm the Fed higher this morning, don't you?
I think if you just look at this economic data...
And the mic's over here, come on.
All right.
The first time.
The first time on the show. Yeah, thanks, Bob. If you look at the economic data, I mean, it just keeps coming in, showing a tight labor market. We keep getting these numbers, strong spending. I agree with Mike. I don't think we're going to get 5-6% GDP this quarter, but we're probably going to get at least 2% GDP and maybe 3% GDP growth. And I think you did hear some of that coming out of Jackson Hole. You look at the core inflation numbers, they've slowed for a couple months. That's good news. Headline inflation has slowed. So there is some good news in terms of price pressure that's a little bit more subdued now.
Right.
But when you look at this economy, the tight labor market, it's going to drive wages. Wages are going to drive prices.
The heart of your academics, and frankly, it goes to Catherine Mann now at the Bank of England as well, is a real humility about what we don't know. Olivier Blanchard calls that other factors. What are the other factors that the low yield people, the rate cut people get wrong?
Yeah, so I think the other factors that we have at play here in the U.S. economy include some of the domestic strength that I was talking about, which is not just the tight labor market, but also the tight housing market. And this is an odd one, and I think you described this cycle as being odd, and it certainly is. Usually you would think mortgage rates move higher, we get a slowdown in housing, and we get a slowdown in house prices. And that happened, but the issue we have now is supply has actually become more constrained in the housing sector than demand. So those households that have an existing home that are paying a 3% mortgage rate, not a lot of incentive to put that home on the market. So that supply is staying really constrained. The Case-Shiller price index came out this week. We're up again close to double-digit percentage increases on an annualized basis, and that's just not going to be consistent with 2% inflation.
Yeah, there's just no inventory in the existing home market. It all is in the new market, which is why you're seeing that bifurcation in housing. Just on the subject of demand outside of housing and coming back to the data of this morning with personal spending up 0.8%, at the same time that personal income actually grew less than expected. How much longer, realistically, could the U.S. consumer live above their means if we're talking about a savings pile that has dwindled, which is what was helping fuel this in the first place, and your income not growing as fast, wages barely keeping up with inflation? Isn't the spending going to have to come to a halt at some point?
Yeah, and don't forget student loan repayments restarting.
Yeah, in October.
Yeah, so there are some headwinds that the consumer is facing here. I think what has happened, though, is we had such an extended period of low interest rates, such an extended period of ample liquidity. You saw credit card debt go down significantly during the pandemic, and now those levels have built back up. Now you're seeing delinquency rates that are getting back to more normal delinquency rates that we would expect in kind of a normally functioning economy. To your point, as the Fed leaves rates higher, we're going to see more tightening of credit. That's going to be a headwind for consumers. Eventually, that will slow the economy. We still think we could see a significant economic slowdown in 2024, perhaps a recession in 2024. But you have to take seriously the data that are coming in, and we still see this really strong spending. Like you pointed out, 0.8 of a percentage point up on personal spending. I mean, it's just a really strong consumer right now.
So if we do get that recession in 2024, but you still don't get 2% inflation, is the Federal Reserve going to tolerate the pain ultimately, do you think?
So that's a really tough scenario for the Fed. I think if you get a significant enough slowdown, you will see some deflationary pressure. But we could have a period of time, and maybe it's going to be an extended period of time, where you see the economy slowing. And to some extent, you see this with the credit that is tightening already, right? We have some signs that things are going to slow down eventually. If inflation was stably at 2%, then the Fed might be a lot more comfortable thinking about cutting rates. I think what we heard from Chair Powell last week at Jackson Hole was that although they'll be attentive to both growth and inflation, right now they really do have to concentrate on those upside risks to inflation. That's where you're coming from. We still have various measures of core underlying inflation that are running too high. And that means that there could be a period of time when you see somewhat weaker growth data, but the Fed is still holding rates higher.
Richard Clarida is identified with this thing DSGE. All you need to know on a Labor Day Thursday is we're not going to do the math. Either I can't do the math. It's that fancy. But the bottom line is, I mentioned Axel Leonovid earlier, that article from years ago, Beyond DSG Models, where he and a team really go after the math certitude, the mathiness of the Andrew Hollenhorst world. Do we have operative models right now? Do we, in God's name, know what we're doing?
So I think that is one of the big challenges here. What is the theoretical framework that we're using to assess the economy and to assess monetary policy? And you heard Powell point to that uncertainty in his comments.
As a non-economist.
As a non-economist, yeah. And so he talked about this navigating according to the stars under a cloudy sky. And what does he mean by the stars? The underlying neutral rate of interest that would neither be restrictive nor stimulative. The underlying natural rate of unemployment. These are important theoretical concepts, but we really don't have a good way of evaluating them in real time. We don't know where they are. So it is going to be this kind of responding to the data. It just comes back to data dependency. If you don't have a strong theoretical framework, then you follow the data.
Yeah, setting monetary policy can be a tricky business in an environment like this one. Can I just quickly ask you about fiscal policy as well? Because we hear a lot about, we have not yet seen things like the CHIPS Act, Inflation Reduction Act, that actually being realized in the economy and making a difference. At what point does what theoretically could be a driver actually become a drag because the Fed might have to respond to those new injections? How are you thinking about that?
Yeah, it's a great point. We're starting to see some things in the data that are at least suggestive that maybe you're seeing some of this showing up. We did see stronger investment in manufacturing. Maybe that's related to the CHIPS Act. But you're right, these things are going to take a long time to actually play out. It's going to take time for that money to come into the economy. At the end of the day, the Fed is not going to kind of look at fiscal policy and then try to directly offset fiscal policy with monetary policy.
It's not their business. Right?
Exactly. The Fed doesn't want to be in that business. So what the Fed is going to do is just look at the data like we got today. If inflation stays cooler, then that's great news, and that's more reason to think that the Fed can be a little bit more dovish here. I think they're pretty comfortable with the level of policy rates. We still think they're probably going to hike one more time in November, but that's probably going to be the end of the cycle. And then it really comes back to this question of when do they make that first cut?
Andrew Hollenhorst with us, and we will continue. We need to do some data check here off the Michael McKee data, as they say. Futures up 10. Dow futures up a nice 0.5%, 164 points. NASDAQ less so. The VIX under 14 to me is a huge deal, 13.79. I should also point out, Kaylee, help me here, oil with a climb, and I'm going to say it's a $6 climb that we've had. We're pushing near $87 Brent.
Yeah, and 82 on WTI. And what was it that Chris Verone told us earlier this week? He could see 90 on Brent. Some of those upward pressures on price of energy. There's a question of how that transmits to everything
I haven't
else.
looked at the chart, but it's in place as well. I've got some dollar strength here, I guess, off the McKee jumble here. Mike McKee digging into the data. We'll get to that here in the coming hours with Mr. McKee. On the Standard & Poor's 500, we are up 0.2%. We say good morning with us, Andrew Hollenhorst of Citigroup. I want to talk about the cardinal belief here, Andrew, where there's a lot of people that remember this yield structure pre-07, and it's all new to people out 15, 16 years. Respond to a Citigroup client saying to you, OMG, we're all going to die because of high yield. And yet we've lived with high yield before, haven't we?
Yeah, I think if you look at the period, roughly 2005 through 2007, it was a strong economy. It was an economy that was producing 4%, 5% nominal GDP growth. roughly 2% real GDP growth and around 2% inflation. And that was an economy that performed that way with 10-year yields around the levels where they are now. So I do think that you have to take a long enough historical lens when you look at this, a long enough historical window. Yes, if you just compare to the post-2008 period, 10-year yields look quite high, and 10-year real yields really look quite high, right? We're getting close to 2% 10-year real yield. But if you look back to that period, which you could argue was in some ways a more normal period, we had kind of a lot of strange things that happened after the financial crisis in the economy, a period when the economy was really digging its way out from that deep hole that it got into. It's not to say that 10-year yields will stay at this level forever, but I think that period, that kind of shows you that you can be there.
I don't want to put you on the spot. 10 seconds. What does the Fed do in September?
September, they pause. I think they pause, but they keep the dot showing one more hike.
See how he does that? He's just a complete victim of the parlor game. Andrew Hollowers, thank you so much. He is with Citigroup and has been definitive with a select group of others, Bill Dudley and others, on the nation needing a higher interest rate structure. Coming up, anticipated, not Max Vanderstappen, the Max Vanderstappen of technology, Dan Ives joins us.
Sports and money, they've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Surveillance, Dan Ives has walked into the room. We had a color correction. We'll get to that in a moment. Futures up 8, week advance, 4th, 5th, 6th day in a row. It's a bull market. Futures up 8, you see that with the VIX. 31 in October. Good morning, Ralph Ancampora, giant of technical analysis. Good morning, Dr. Yardeni, giant of Yale. And years past, C.J. Lawrence. We're going to go higher from October, they said. The VIX was 31. It's now 13. This gets your attention as well. Due to the importance of our guests, the Max Verstappen of technology, we'll get the movers out of the way to get to Mr. Ives.
Yeah, I'll do it very quickly. Starting with Salesforce, up 6.5% in pre-market trading at the moment. Wow. Revenue and profit forecasts topped estimates. They're getting some progress in that campaign to cut costs, some cooling concerns around a sales slowdown as well. So that's not getting a nice reward. But Dollar General, Tom, getting hammered in pre-market trading, down 17% after cutting its outlook again. They say earnings will tumble as much as 34% on a per-share basis during the current fiscal year. So pretty brutal for that low-cost retailer. And then finally, AMC. Tom, Taylor Swift is coming to the movies, the Eras Tour in North America, October 13th. And AMC is promising that they will play that at every one of its U.S. locations at least 4 times a day Thursdays, Fridays, Saturdays, and Sundays. That stock up 6.7%.
I got to where Paul Sweeney is on this, and off of Barbie and Oppenheimer, changed behavior. Oppenheimer doing $700 million. I talked to Paul yesterday. He said he's not sure it could get to $1 billion. Let's do a movie on a theoretical physics guy from 1949. That'll work. Let's greenlight that.
Yeah.
But Taylor's like a shoe-in, right?
Oh, for sure.
It's like a huge deal.
Taylor, Barbie, Beyonce. It's a cultural moment, Tom.
It's a cultural moment. It's a cultural moment when Dan Ives walks in the door. We're going to do that, and today we're going to do something different. Really drill down and focus on Apple. We do this, and when I look at Mac Rumors, which is like, you know, all the gossip out there, and of course we're advantaged by the wonderful work of Mark Garman. Rumor features 6.1 and 6.7 inch sizes, dynamic island for all models, periscope zoom lens for pro models, USB-C port, lose it, dumb idea, Tim, Qualcomm modem chip. It's not just another phone, is it, Dan?
It's not. And I think it speaks to what is going to be a mini super cycle playing out for Apple. You know, I think it's been one of the things that you've seen investors, I think, have underestimated this upgrade cycle. I mean, we believe 240 million of 1.2 billion have not upgraded their phones in 4+ years.
What's your terminal timeline when you analyze this financially? I'm enjoying a 30 multiple on Apple now. I've got low single-digit revenue growth. The world's coming to an end. Yes, service is doing better and all that. How far out do you have to go to justify the marginal share purchase?
I think you have to go out 2 to 3 years, in my opinion, because what's really happening here is you're actually seeing a renaissance of growth on iPhone, especially when you think about constant currency. You look at services in terms of what's happening there, now double-digit growth. Look, Tom, I think some of the parts, we're looking at a $3.5 to $4 trillion market cap in the next 12 to 18 months. And I think it just speaks to our view where this is, for Apple, they continue to play chess, others play checkers.
What about China as a factor in this story? Talk about playing a game here. Huawei introducing a smartphone. Chinese state media talking it up as just being in a competition between the U.S. and China in terms of this tech. How real is that threat, especially for the Chinese consumer, which Apple does rely on?
Yeah, look, if you look in China, I mean, Cook and Cupertino, they've gained 300 bips of market share in China. That's the irony, is that right now, despite the worries about China, that's actually been the core hearts and lungs of the success story. And I think when it comes to the actual upgrade cycle that we see with iPhone 15, I actually think China is going to be a tailwind. And I think it just comes down right now. It's Apple's world. Everyone else is paying rent. I believe that they will regain more and more share in smartphone. I think, look, Samsung continues to be an Everest-like uphill battle.
Okay, that's in smartphones. What about in everything else? Got a lot of products here in the Apple ecosystem. And our Mark Gurman, to your point, always breaks news on Apple, Tom. They're testing 3D printers to make the stainless steel watch.
Well, I think that, look, I mean, and Gurman knows Apple as well as anyone. I think the big thing here is going to be what I believe is the grand slam, is the AI app store that Apple, we believe, will introduce in 2025.
I got 8 questions. Let's go there quickly. AI, they don't have a plan. Baloney. Cupertino has a plan. What's their AI application of NVIDIA's wonderment?
Look, it comes down to, right now, it all starts with developers building more and more apps that I believe are going to be ultimately Apple specific. And I think it starts with what we see right now, that ultimately is going to be more of a monetization on services. I believe, look, I think...
You think AI is going to go over to the service sector?
I think AI could add $30 to $40 per share to Apple stock, which is why, as Tom's talking about, I think right now, anyone that thinks that Cook doesn't have an AI strategy, I mean, that's like saying Steph doesn't have a
Just because of time, I got CapEx. I got all this growthiness in Apple, blah, blah, blah. But I got CapEx, which is basically flat pre-pandemic. I did 10 billion large CapEx pre-pandemic. I'm only doing 11, 12 billion more out 2024. How are they generating their growthiness without a buildup in CapEx?
It's because of the install base, because you have the golden install base of Cupertino that continues to be underestimated by the street. And I think that's, now I do believe CapEx is going to ramp up over the next 2-3 years between what I view as the AI App Store as well as the Apple Car 2026.
I want to talk about the hope and prayer, which is forget about this $1,000 thing. you do a monthly plan, and you do it through a phone provider. Last time around, T-Mobile and the rest of them stepped up big. Have a free iPhone. Are they going to do it again?
They're going to step up even more this time.
Even more this time?
Even
Discuss
more
it.
this
That's
time.
important.
Because I think the carrier discounts that you're going to see are going to be jaw-dropping. I think there's a recognition about that install base. They know the numbers. They know that there's a massive opportunity to put an iron fence around
This is
it.
critical. You think T-Mobile's going to reaffirm Magenta with the new iPhone?
Oh, I think it's not just T-Mobile. I think when you look at Verizon, AT&T, and the types of carrier discounts we see here, it speaks to why, even though I believe it's $150 to $200 price increase that we're going to see, this is something where it's going to be a massive cycle for Apple. And I think that's why even out of our Asia checks, you've seen what I view as not just flat to an uptick year over year for iPhone 14, despite many bears saying, that the world's coming to an end.
There's a lot of stocks in your coverage, Dan. Is Apple your favorite for all these reasons that you're outlining?
Look, Apple continues to be a table pounder. Microsoft as a cloud table pounder. Of course, Tesla is our EV play. Look, I view it, in my opinion, the new tech bull market is here. And I think this is just really the start of the next 18, 24-month bull cycle.
And you think that lasts, even if we have higher for longer rates from the Federal Reserve? Is that not really relevant to these names?
Look, I think it comes down to, we believe Fed cuts at one point next year, and it just comes down to the growth. It's a 1995-like cycle in terms of AI. The bears will come out of hibernation mode. They've called 10 of the last 2 downturns.
Yeah, I look here, and I look pre-Labor Day, and I'm just so thrilled you came in understated. I mean, we're trying to do a serious financial show here. You got the famous Ive shoes, and now you matched them. You got so many endorsements going on, and you look, I can't keep up.
Look, because I'm in the presence of Keen, of course, I had to dress a little understated.
Yeah, you did. But notched it down.
But I notched it down a little.
How do they greet you at Cupertino? You walk in looking like a frosted lemon at Cupertino. How do they respond?
When you come in Cupertino, it's really, they're like, okay, could this potentially be some sort of AI strategy?
What's a chip surprise iPad, computer, phone at the stupid, silly Cupertino rollout in September?
September 12th in terms of drum. I think the surprise is going to be the chip rollout.
I agree.
And I think the biggest surprise is going to be AI functionality that we
They're going to outline their AI
I believe
strategy.
they will discuss AI strategy despite having no strategy, according to many of the bears.
Dan Ives, thank you so much. We
Thank
got
you.
through that meta-free. See how we did that?
We did indeed. Can I just, for the radio audience who can't see Dan Ives, yellow pants, light green jacket, kind of a tie-dye situation shirt. And
No, it's like
really
Chagall.
cool
It's
Nike
much more of a
sneakers.
Tuileries Paris kind of look. He's going like Saint-Tropez.
It's just like the last day of August, little last taste of
It's
summer
somewhere
wardrobe
between
here.
a Saint-Tropez, a Swift concert. It's a combo.
I'm dressed like a funeral
It's a
except for
vibe.
my UVA tie. He's been so right. And I must say that he takes it with grace as well. We need to say thank you, Kaylee, Lisa, John, I'm abandoned for tomorrow. There will be a jobs report tomorrow. Michael McKee and Ms. Greifeld will be with us here. It'll be a most interesting day. We leave it. Futures up 9. Stay with us through the day on television and radio before Verstappen at Monza.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. From the world of politics
We're not going to be relying upon countries whose values we don't share.
to the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern
It's the one area, really, of bipartisanship.
I think we're getting more, but
That's optimistic.
and Joe Matthew.
the debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee
The
Langs.
door was open for regulators to do more. And that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
That really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience would get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
So let's go inside the boardroom. Let's suppose you win a proxy fight and or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with the plan.
This is Bloomberg.
A four-day winning streak on the S&P 500, attempting to make it day 5. Live from New York City this morning. Good morning, good morning. Futures positive. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, another Fed official calling for patience. The ECB stuck between a rock and a hard place and hoping the worst might be over in China. We begin with the big issue. Is bad news good news?
Bad news has been good news.
Good news is somewhat bad news.
Bad news is now good news.
It'd be really nice if good news could just be good news and bad news could just be bad news.
We're in that mode where the market is cheering weaker economic news.
We had bad news in terms of cooler data on jobs and also consumer sentiment.
The bad news in terms of weak data is kind of good news in the sense that it might mean the Fed is done.
The Fed is going to have some pressure.
Maybe the Fed's going to pause and that allows this cycle to carry on.
In the shorter term, there is some evidence that this is actually working.
That type of environment doesn't tend to last an extended period of time.
We're in this tricky part where you're coming down from really elevated levels and you're normalizing the data.
We need to be careful, though, that we don't get too excited too quickly.
That fine line is going to show
bad news eventually becomes bad news.
Let's discuss. Daryl Cronk of Wells Fargo, Joanne Feeney of Advisors Capital Management. Joanne, you've got to translate this. If bad news is good news, what is good news?
You know, John, I think the longer this takes, the better. If we remember where and how all this started, this inflation problem started with the pandemic and started with a shortage of goods. Lack of goods, higher prices. We are still working through that problem. And the longer this takes in terms of gradual rate increases or sudden rate increases, but a gradual decline in inflation, the more supply still has a chance to catch up. We are dealing with a U.S. economy that has a fundamental shortage of labor, which is what's keeping services provision tamped down, which is still keeping goods supply tamped down. And that's still fundamentally the problem behind inflation. So the longer this takes, the more patience the Fed has, the more patience the markets have, the more likely it is that supply catches up to demand.
Daryl Cronk, what's the difference between unwelcome downside surprises and desirable downside surprises?
Well, you got to thread the needle, and you need a Goldilocks scenario there, John. I mean, I think what we're seeing right now in the economy is you're moving from a world of lagging to a world of dragging, right? We know that policy, financial conditions, and credit conditions have all have that lag effect, and we've been working our way through it. Now we're actually starting to see it in the data, right? Whether it's consumer confidence ticking down this last month, whether it's the ADP report yesterday and weaker jobs, even this morning on the PCE, I would say, wages came in less than expected, consumption came in better than expected. I'm not sure that's a great thing. And if you actually look at the Fed's preferred measure of super core, which excludes housing, it's still running over 5% year over year. So we're not convinced the Fed is done here yet, and nor should they be.
Well, growth has been solid. Growth is above trend, and they've talked about the need for a period of below-trend growth. Now, Darryl, let's build on that. Stuart Kaiser of Citi has pointed out that upside inflation risks require below-trend growth. Now, if that's the objective, do you think equities are priced for that reality?
I don't think they are. I mean, here's the reality. As we sit here today, John, you're sitting at a 19-year high on mortgage rates, you're sitting at a 14-year high on real yields, and you're sitting at a 19-year low on equity risk premium. Equity risk premium meaning, am I getting paid to take equity risk, to your question. Today, I'm just not, right? I mean, we know that all of the return this year has been multiple expansion. Yes, 2024 earnings growth has ticked up to 11% for next year, but you're starting to see even some of the street rationalize that and say, boy, that looks too high to us, and bringing it down.
Joanna, it's that old cliche that money goes to where it's treated best. Is it treated well in equities now?
I think what we're seeing, John, is a real separation of the good stock opportunities and the ones that are overpriced. I mean, look what happened to Dollar General this morning, right? What we're seeing is that investors need to be really selective in where they go. All of equities, the whole market, looks expensive on average, but that's not what you need to do as an investor. You don't have to own the whole market, and you can avoid, companies like a Dollar General, which is really playing to the low-end consumer who are most squeezed by inflation and the pace of wage increases, which hasn't really kept up until recently with inflation, whereas other parts of the market are getting rewarded. There is growth out there. It's just not an average that's particularly attractive. But look at the stuff related to AI. That's real, and that's going to grow over time. So there's growth out there, but you have to be really selective in where you go find it.
Dollar General. Let's select that one. Let's bring up the stock just briefly. That stock is getting absolutely hammered in the pre-market. We're down by 17%. Darryl Cronk, is not just them. It's Dick's Sporting Goods. It's Foot Locker. Even Walmart and Target were warning about a softer consumer potentially off the back of student loan repayments resuming later on this year. Darryl, should I listen to them, or should I look at the broader economic data, which tells me so far so good in 2023?
Yeah, I think that is, you've been asking that question this morning, John, and I think it is exactly the right question to ask, right? Because a lot of the economic data has the lag effects that we know about. We're looking at just this morning, PCE data from July, right? July is, as we get ready to turn into September here, is in the distant rearview mirror. If you look at Dick's, if you look at Peloton, if you look at Dollar General this morning, they're all telling you the same story. The consumer's weakening and weakening at a quickening pace. What I thought was interesting out of the earnings season, too, is if you actually listen to the conference calls, you heard companies like Macy's and Nordstrom's also say that credit card delinquencies were rising, right? So not just the slower spending numbers and slower revenue and sales, but actually we're seeing deterioration in the credit conditions and the repayment side of it, which tend to be more at the high end of it. So I think you're seeing it broadly across the retail board. I would take that canary in the coal mine and listen to it. I wouldn't dismiss it.
I'm loving some of the research out there at the moment. Allow me to bring you two quotes, one from Morgan Stanley and a counterpoint from Renaissance Macro and Neil Dutter. This from Morgan Stanley on Barbenheimer and Taylor Swift. They said real consumer spending is tracking 1.9% quarter-on-quarter annualized growth in 3Q23. They estimate Barbenheimer, Taylor Swift's The Eras Tour, and Beyonce's Renaissance are combined contributing 0.7 percentage points to consumption growth this quarter. They think that's going to fade in the quarters to come. It's the end of the Barbenheimer bounce. This is what Neil Dutter's got to say back to that this morning. There was quite a bit of enthusiasm for Barbie and Oppenheimer, which were both released in July. However, real spending in motion picture theaters remains about 11% below its level 3 months ago. Not sure we should expect much of a drag later as a result. Joanne, with all of that in mind, jokes aside about going to the movies and paying too much money to watch Taylor Swift, where is that drag coming from the consumer that so many people are anticipating into year end?
Well, it's pretty clear that even though real personal income has been rising over the last, about year, it's still the case that consumers are burning through their savings pile. And at some point, they have to face reality of dealing with those higher credit card bills, which they are now facing, higher student loan costs as they have to begin to pay some of that back. So I think it's the drawdown of savings that partly is the headwind. It's the pile up of inflation, right? Inflation isn't reversing. It isn't becoming negative. Those prices that have gone up are still going up. They're just going up at a lower pace, which means that it's still more costly to meet your expenses every month. So all of these things are going to weigh on consumer spending and cause that shift, towards necessities that we've seen start, and we've seen in the reports of Target and TJ Maxx and Walmart, right? And that ultimately could then finally affect the services side of the economy. We haven't seen much of it yet, but we're likely to see that as the next area where consumer spending starts to fade a bit.
20 minutes away from the opening bell, equities fading just a touch here. We're still up by 0.1%. Tons of data this week, job openings, the ADP report, claims this morning, payrolls tomorrow. Mike McKee has it all. Morning, Mike.
Morning, John. You asked a little bit earlier whether good news is bad news or vice versa. Well, I've got an answer for you. Both. You take a look at the PCE numbers today, the inflation gauge the Fed follows, and you see on a month-over-month basis that both core and headline rose just 0.2. You can see the trend down. That's what the Fed is looking for. But Darrell mentioned the super core number. That went up. That's Jay Powell's number with core services ex housing, and that went up 0.5% during the month, and it is running around 5% for the year, so it is still significantly higher. What does that mean for the Fed? Well, they'll be looking at all these numbers, and one of the things they will be worried about is personal spending. Even though incomes went down, spending went up by 0.8% more than expected, certainly more than the prior month. How are they doing it? Well, that was the question that was just asked. Look at the savings rate. Drops to 3.5% from 4.3%. So does that suggest that consumers are going to be pulling back? We're going to have to see if wages go down, wage increases go down, and savings go down. Then we'll look for those credit cards to see what they're doing. The other number out today that everybody's been watching is jobless claims. We have obviously the payrolls report tomorrow. Jobless claims, very interesting. I put continuing claims up here because they have barely moved as well. And what you can see is that every time you go into a recession, continuing claims, and the same is true for initial claims, are rising significantly. Take a look on the right-hand side. I took out the pandemic number because it throws the scale off so much. But if you look at where we are now compared to where we were going into previous recessions, it is not a worrisome sign. There is still labor hoarding going on. We may be hiring fewer people. We'll find out at 8:30 tomorrow. But we are not letting them go in any significant number. And those who do let go are apparently finding new jobs.
Mike McKee will be here at 8:30 tomorrow.
I'm the only one.
Mike McKee will be.
Tom.
No, TK wants everyone to know that Tom will be here as well. Mike McKee.
Taylor Swift will be here.
Taylor Swift too.
And everybody tunes in, right?
Beyonce, everyone, Max Verstappen. Who else we got, Mike? Mike, thank you. Wanted to go to this, Darrell Cronk. This from you, a stat. You say history shows the S&P 500 doesn't bottom until on average 6 months after the first Fed rate cut. Now, Scott, is that just a nice, interesting stat, or are you making a forecast? Darrell, rather,
no,
please.
I mean, that's historically true. Oh, yeah, sorry, John. That's historically true. It's happened almost every time. And it makes sense, right? Because what happens is the yield curve bull steepens as people project that the economy's slowing quickly, economy goes into recession, Fed has to cut rates, and then what happens is equities tend to bottom after the first rate cut. Most people miss that. You can fact check it back for the past, basically, 13 monetary tightening cycles since 1970, right? Every time it's almost happened. So if you price the first Fed rate cut out into 2024, we still might have a long time here before we start to see where the equity cycle ends up. And just to the point, John, I think Mike McKee just nailed it. I mean, he was spot on exactly the super core and the assessment. And labor is key as we head into Labor Day, right? The economy needs to labor on, or we're going to have labor problems.
Darrell, I think we've been talking about that low in October for so long. I forget that it's almost been a year. It's September this weekend. It's tomorrow.
Yes.
We're 11 months into this, and we've been talking about retesting the low. Darrell, do you think we really could retest the low of last October?
I think it's a stretch to get down to that 3,600 level, and if it did, it would probably be a generational buying opportunity, John, to be frank, right? Because valuations and your risk reward would flip so strongly, and there's so much liquidity out there that your buyers would step in heavily. But I do think, you know, where we do our work and analysis, we say the risk reward starts to flip somewhere around 41 to 4,200, meaning at that level or below, equities start to become attractive again based on earnings and valuations and the equity risk premiums I mentioned before at a 19-year low, meaning I'm not getting paid to take equity risk at 4,500 today.
Derek Cronk, Joanne Feeney, sticking with us. More still to come. We'll talk about China and the ECB and global equity markets as well. Local equity markets, stateside, the S&P 500, just about positive here by 0.1%. Going into the opening bell about 17 minutes away. Let's get you some movers. Here's Abby.
Hey, Don. Well, we are looking at a fifth update potentially for the S&P 500, the longest winning streak since the middle of June. Helping out right now, Salesforce.com. Shares are popping higher, sharply higher, after the company put up a very nice beat. They beat earnings by 12%. The sales numbers were fine. It looks like their cost-cutting campaign has really eased fears. They've also raised the full-year view, profit view, and margin outlook. So right across the board, and if you recall earlier in the year, activists were really pushing for this kind of improvement. They got it. Okta, the application software company, they beat top and bottom line estimates as well. They also raised the full-year view. There's margin improvement there, and apparently the company's sales strategy, the street likes it a lot. That stock up about 10%. Now, there's one here who clearly does not look like the others. Dollar General plunging down 17.3%, a miserable quarter. Adjusted, yes, very brutal. Adjusted earnings missed, the rising labor costs, and of course, they slashed the outlook again, John.
Amazing. Abby, thank you. A fifth of the market cap going just like that. Expecting that to happen around the opening bell. We've seen that with several big name, big brand retailers over the last week or so. I'm thinking of Dick's Sporting Goods, Foot Locker, and a world of pain over the last couple of weeks off the back of earnings. Coming up on this program, Eurozone inflation, keeping the pressure on the ECB.
We have more slowdown than the US, but still with more inflation. And that's the conundrum for the ECB. You can see that the economy is not doing well at all. You know, Germany was in recession at the end of last year, beginning of this year. But people have not yet seen the impact truly on the labor market, and wage negotiations remain very, very tense.
The latest on the ECB, on Europe, on China, coming up next.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip. A bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. I think the way they got a date was to impress the females by making loud booms.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
The way I
think about China right now is one word, and that word is traction. So when are all these little drips and drabs of policy going to actually, kind of do their thing, get traction, and move the economy forward? One, PBOC is injecting liquidity. Two, stocks trade cheaper to the U.S. than they have in 20 years. Three, there's no confirmation in this negativity that everyone seems to love to talk about. The consumer in China is not like hiding under a rock. They have plenty of room to consume. It is a confidence issue.
Jay Pawlowski of TPW weighing in on China's recovery. China's manufacturing contraction easing just slightly, as some investors say relief for equities could come soon. This is Eurozone inflation showing no signs of letting up. The consumer prices rising in August, presenting a problem for ECB officials as they weigh the risks of a September pause. Team coverage starts right now with Bloomberg's Enda Curran in Washington, D.C., Maria Tadeo over in Brussels. Maria, let's start with that data out of Europe. Rock and a hard place for the ECB and Christine Lagarde.
Look, and it is so tough for the European Central Bank at this point because it really is a real conundrum when it comes to the economy. And of course, we know this is a single mandate central bank and they focus on inflation, of course, at 2% target. They also keep an eye on the macro data. And we know the risks are all pointing to the downside for the euro area. When it comes to the inflation data today, you did get headline inflation come in at 5.3%. The estimate was that it was going to cool more than expected, but we saw that was not the case. I would add, however, a caveat to that headline inflation number today, because if you look at some of the drivers behind it, a lot of that had to do with energy and fuel. That was the case for the Italian print, it was the case for the French print, and it was the case for the Spanish print. So we know the European Central Bank will probably skip through that. When you look at core inflation, again, is 5.3%. The European Central Bank would love to see that way lower, but that is where we are. Nonetheless, when you look at components inside it, you could argue it is moving in the right direction, just not fast enough. And fundamentally, Jonathan, the real question here, and that decision will hinge entirely on this question, is whether the European Central Bank believes the transmission is working enough so that every hike they've done until now can get inflation back to 2%. If they believe that is not the case, then there is still that possibility of a hike in September. I would not rule it out, and I do not think the data that we got today has flipped it either way.
Europe doesn't just have an inflation problem, it has a growth problem too, and the blame game shifts to China for the global economy, particularly over the last month or so. Enda, can you help frame for us the latest data out of China and the policy response to it?
So the PMI data, the official PMI data, showing some improvement. John, nudging towards 49.7, suggesting that maybe the manufacturing side is bottoming, new orders picking up, construction doing well, perhaps suggesting a turn in the global trade cycle. That's the good news from the PMI. The bad news is the services side of the official reading still pretty weak. We know ongoing turbulence in the credit markets for those big property developers, more negative news on the property developer Country Garden overnight. The authorities coming out with fresh steps as well to bring down the cost of down payments on properties and, of course, on repaying mortgages. There is, though, a body of thought emerging that the doom and gloom on China's economy is overdone, that China's stock market, for example, is now a buy, that there is value there. So those bulls are pointing to PMI as potentially a bottom, but you'd have to say on the real estate side, we don't yet see any signs of a turning point.
Enda, thank you, sir. Alongside Maria on the latest for the data worldwide. Daryl Cronk, Joanne Feeney back with us. Joanne, it's not just the data in Europe. It's not just the data in China. It's the inability seemingly to respond to it, particularly in China. And China, to go one step further, Secretary Raimondo talked about the lack of predictable regulations in China. Is China investable from your standpoint?
Yeah, it's definitely a challenge, Sean, for a lot of reasons. I mean, one is for what Commerce Secretary Raimondo pointed out, which is that the unreliability of the government's policy towards the private sector makes a risk hard to assess. And so one has to be extremely careful about picking and choosing one's spots, hopefully finding companies that are less, in the view of the Chinese government as sensitive, to their cultural stability needs. I think that is an unpredictable risk, and that makes it very hard to invest. But again, you can pick your spots. I think more broadly, though, John, the concern, and I think the unrealistic hope of some investors may be that China's growth is going to suddenly return to prior levels if only the government does the right things in terms of stimulus. And that is, I think, a fundamental misunderstanding of what has been driving growth in China over the last decades and where it's likely to go from here, which is lower.
What a tough backdrop. Daryl Cronk, final word, please.
Yeah, I think that's exactly right. I mean, look, when you look at China, it's in the midst of a property crisis. Activity is faltering, prices are declining, growth is slowing, right? So it makes it really difficult, John, to get excited about putting money to work there. I think the Chinese government is trying to shift the stimulus conversation from a macro, big China government stimulus to the local stimulus conversation. But I would steer clear there now. I think it's difficult to make a good case. And then on Europe, I would just say one word: stagflation, right? Really slow growth, high inflation. It's a conversation nobody wants to have, but it's the reality of what Europe is dealing with right now.
Daryl, thank you, sir. Spent the last 15 minutes trying to work out why I called you Scott. I still don't know. Daryl, I apologise. It's good to see you, as always. Daryl Cronk, Joanne Feeney, thank you. Coming up, the morning calls, and later, JP Morgan's Jack Caffrey with the market on a 4-day winning streak, attempting to make it 5. Your equity market up by 0.1% on the S&P 500, just a day away from payrolls in America.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Five minutes away from the opening bell and trying to make it a 5th day of gains on the S&P. Equity futures on the S&P right now positive by 0.1%. That 4-day winning streak, the longest since the middle of July. Let's see if we can make it 5. That's the price action. Here are some morning calls. First up, Morgan Stanley upgrading 3M to equal weight, 113 price target, seeing improving fundamentals and achievable consensus margins. JP Morgan downgrading Hostess Brands to neutral, $28 price target, citing media reports about the company potentially being for sale. That stock is unchanged. And your third and final call from Wells Fargo, downgrading Victoria's Secret to equal weight, $18 price target, pointing to unfavorable sales trends and share dynamics. That stock is down by another 3%. We'll be talking about Dollar General absolutely cratering going into the opening bell after they cut their outlook. We'll have that story around the open in about 4 minutes' time, and we'll catch up with this man right here, Jack Caffrey of JP Morgan. Your opening bell up next.
adults are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Moment news breaks. No one covers the world like Bloomberg.
On the AI question, what we don't really see is Apple doing a knee-jerk response and moving into the domain of generative AI.
Supporters of President Recep Tayyip Erdogan celebrating late into the night, dancing and singing.
We have a fundamental reassessment of everybody's capacity within OPEC. Should we talk about $95 and $100 oil again? Not for a while.
Bloomberg, your global business authority.
The economic data so far this week doing no harm to this equity market. S&P 500 futures just about positive by 0.1% on a 4-day winning streak on the S&P, about to make it 5. And the S&P trimming a monthly loss down to about 1.6%. 1.6% is nothing really at all, given the grand scheme of the rally so far in 2023. Let's your opening bow, switch on the board and get to the bond market. The harm early this month done by surging bond yields. Over the last week, a whole lot lower. Down another basis point this morning at 4.1%. Remember, a week or so ago, a week and a couple of days, 4.36 on a 10-year, all the way back down, sub 4.1. Earlier on in the last 24 hours. On a 2-year, quite a range this week, from 5.1% all the way back down to the 480s. On a 2-year right now, 4.89%. In the FX market, euro weakness. This is a problem. The euro against the dollar, 108.64. This is a problem for ECB President Christine Lagarde. What does she do on September 14th, stuck between a rock and a hard place? That rock, sticky inflation, that hard place, growth, just ain't good. In the commodity market, just briefly, about 83 on WTI, an 82 handle, just short of $83 a barrel. Brent crude at the moment, WTI there, up by a little more than $1. One stock to watch at the open, Chewy, Evercore downgraded the stock. Analysts saying, quote, what makes us incrementally cautious is the disappointing second quarter decline in net ads, as well as management's subdued outlook for the second half. Abby has more. Hey, Abby.
Hey, John, and it's very disappointing to investors, too, with the stock now down about 11%, heading to its worst day since May of 2022. So they missed earnings in a huge way, down 61%. They put up at 4 cents, literally 4 cents in adjusted earnings. Sales were about flat, but yes, disappointment on the part of the street that they would, Evercore ISI, as you were just mentioning, in particular, would prefer a more compelling valuation level, which is a way of saying that this stock is too expensive for the numbers that they're putting up. Morgan Stanley has kept their equal weight rating, saying that the negative net ads in the second quarter were offset by better than expected profitability, but the net ads have continued to disappoint, and the risks largely priced in ahead of the results. Well, I would disagree with that, considering that, again, that the stock is down about 11% on the year, or on the day, on the year, down 26% into today. So these results aren't shocking, but just disappointing to the street. I would add one more thing, John, which is there's a 17% short interest on this stock. So some investors today doing very well. These are probably the results that they would expect. It's also interesting just to think about all of the commentary out there about how Chewy.com is taking so much business from the smaller pet companies, and yet from a profitability standpoint, they're really having a hard time here, and from that net ad standpoint.
Stock down 11%. Abby, thanks for that. About 2 minutes into the session, 5th day of gains on the S&P 500. Longest winning streak we closed here, going all the way back to the middle of June. No drama at the headline level on the S&P, just an inch higher by 0.1%. You want some drama? Check out this. Dollar General cutting its profit forecast for the second straight quarter on rising labor costs and softer sales trends. The CEO saying this: while we're not satisfied with our overall financial results, we made significant progress improving execution in our supply chain and our stores. Simone Foxman, that stock down 16%.
Yeah, shares fell about 20% last time it missed earnings last quarter, and this is the biggest drop since then. We're at the lowest level since March 2020 here. The results really pretty ugly. In the second quarter, comp sales actually fell slightly by 0.1%. They were anticipated to rise about 0.9%. The thinking that more people, a troubled consumer, would trade down and go to Dollar General doesn't necessarily seem to be so, because revenue from really all segments came in less than anticipated. But I think what really analysts are focusing on here is the guidance. Inventories have been on the rise, up about 8.5% from a year ago. The company's saying it needs to invest there, also invest in labor to eliminate shrink, make the shopping experience better. All that is going to add up to a $170 million charge in the second half of the year, and therefore we see comp sales for the year expected to be either between -1% to 1%, where we were previously looking for 1% to 2%, and the street was expecting $10.03 a share. Now the company says $7.10 to $8.30. Paul Lopez of Citi says this is a much bigger cut than we had anticipated, even though we did see one coming.
Simone, thank you. Stock lower by 16% about 4 minutes into the session. I want to turn to Shopify. The company's striking a deal with Amazon to allow merchants who pay for Shopify's e-commerce tools to use the Buy with Prime logistics network. An Amazon executive saying this: we're excited to help merchants not only grow their businesses, but also save time and resources. Katie has the story. Hey, Katie.
Hey, John. Yeah, Shopify soaring on the heels of this news, currently up about 6% from the bell. Now, with this tie-up, Shopify's U.S. merchants will be able to tap into Amazon's logistics network via its Buy with Prime tool. Specifically, that allows merchants using Amazon's payment and fulfillment services to include the company's checkout services and shipping guarantees on items that are sold on their own sites, which is interesting. So Amazon, it launched Buy with Prime last year, and at the time, this was seen really as an effort to blunt Shopify's momentum. But obviously, the optics a little bit different this morning. Now, the sell side broadly positive on this deal for both companies. Citi notes that this further enhances the value of a Prime membership, while you have Oppenheimer's Ken Wong saying that this should improve Shopify's merchant fulfillment experience. And as such, you can see both companies up this morning. Shopify, again, up about 6%.
Katie, thank you. Moving higher on that stock, turning to another earnings story, Salesforce, easing concerns about a slowdown, giving a revenue and profit forecast that topped estimates. However, Citi analysts saying the software company is, quote, not out of the woods yet, particularly with a continued tough macro environment. Ed has more. Morning, Ed.
Yeah, good morning, Jonathan. Salesforce up 5.8%, holding its early gains from the open. The story really clear. Salesforce and CEO Mark Benioff really focusing on profit, listening to activist investors, which has been a story over the last 12 months. In July, Salesforce raised prices for the first time in 7 years. Job cuts have started to take effect. Salesforce talks about how headcount will be down 10% by the end of the fiscal year. And broadly, analysts are focusing on the outshining and performance of operating margins versus the slowdown in top-line growth. Revenue of $8.6 billion in the fiscal second quarter just gone represents year-on-year growth of 11%. Going to Citi's point, John, this is a company that on the top line has historically grown between 20 and 30%. There is a concern about growth long-term, but adjusted EPS of $2.12 per share, above analyst estimates of $1.90 a share. In June, Salesforce announced this new suite of artificial intelligence-backed tools. The per-user, per-person cost, $7,700. So you go to the forward-looking guidance. For the fiscal third quarter, the period ending October, they see sales $8.7 billion, which is slightly ahead of what the street thought. But for the full fiscal year, they've also upgraded their forecast for sales of $34.8 billion. And key to what the sell side's latched in on, operating margins have been boosted by 2%, full-year fiscal operating margin 30%. Sort of symbolic, at the beginning of the year, Bain Consulting carried out a strategic review of this company. It's now closed and finished, and the company kind of hinting that this is a part of the result that you're seeing.
Ed, thank you, mate. Stock is up by almost 6% right now, 7 minutes into the session. Here's a bullish view on the name from Dan Ives of Wedbush, raising his price target on the name from 240 to 255. Salesforce came out of the gate swinging, featuring a Djokovic-like performance. Classic Dan Ives. Strong Salesforce numbers and outlook is a huge barometer for the overall IT spending environment, with the street coming away with a more bullish vibe with the last few quarters. That stock is up by 5.4% to 226. Dan Ives at 255 now from 240. 8 minutes into the session, broader story, S&P up for a fifth day, this time by 0.25%. Jack Caffrey, looking at the move in bond yields, saying this: all markets seem to be living in and reacting to the bond market's mood swings. The axis since shifted most recently to the idea of getting ahead of when the Fed calls it quits, with its hawkish rhetoric, forecasts and dot plots. Jack, I'm pleased to say, joins us right now. Jack, wonderful to catch up with you, sir. Let's start with the dividend growers. I know you like those names. Why is it a good time to shift to them right now?
Well, I think at the margin, if you start coming back to dividend growth, you're moving yourself away from the more extreme tails of the market, either the high secular growth names with embedded high expectations, and that to some extent might require a continued slowdown in the economy and a more dramatic decline in interest rates from here, or from having to make a call on whether economic growth actually reaccelerates that tends to drive the deep cyclicals. So, if you will, dividend growers can be almost more core than core within the broader equity market and take away that need to be right on the timing, which has, I think, been troubling for a lot of people this year.
Jack, isn't
real
there
challenging,
a bond market call embedded in your call on dividend growers, though?
There is a yes, to the extent that we now live in a world where dividend yields are below bond yields. There is something there, but if you come back again by focusing on growth rather than dividend yield,
got it.
And so many investors conflate the two. When you think about dividend yield, most investors actually are saying high dividend yield, and those are like buying bonds. And if you're buying that sort of stock that has like 2-3% dividend growth, you actually haven't been keeping up with inflation over the last several years. And so you have certainly seen those stocks behave more like bonds than like stocks, places like in the utility sector and some consumer staples. Coming back to perhaps lower dividend yields, but where dividends are growing at 7, 10, 11% a year, you actually wind up better protecting your purchasing power in an environment of still stubbornly high inflation against what the Fed would like it to be, and when we might start talking about how close to 2 is 2. Is 2.4 close enough to 2 for the Fed to say we've won? And so come back to this idea that if I can double my dividend over 7 to 10 years, actually you get growth income. And I think that's what really drives purchasing power protection and ultimately becomes very powerful in the stock market over time.
Jack, you and I have talked about housing and the housing sector and the names around it that benefit from what happens there. This story now, this bullish thesis around home builders is so well understood, given the distortions in the mortgage market. Jack, where are you now on that call for the home builders and the names that work with those names?
Well, I think when you look at the home builders themselves, to some extent it gets a little trickier here just because they effectively, they're helping support their sales by becoming bond traders themselves, effectively offering a buy down of current mortgage rates, tacking that onto your purchase price. But you can only do that for so long if interest rates remain sticky before you start having some more problems. But they really are the only material supply in the market. And so for someone who has to find a house or is moving or just is outgrown where they are, you're basically forced to look at new construction. I do think, though, that home improvement actually probably has more legs than people think, because this can become really the renovation economy. If you're looking at the average mortgage, 3.5% against a headline mortgage of 7%, you start thinking it becomes easier or more economical or more efficient to actually renovate your house, maybe add an extension than it is to actually take on a whole new mortgage, assuming you could even find inventory to buy. And so much of what I hear about is being cash buyers. So people aren't even interested in the mortgage market because they're being outbid for people who actually are desperate to find that new house, admittedly more in the suburban New York market, and where home builders really dominate, say, the southern markets where people have been moving to.
So, Jack, if we're in the renovation economy, can you help me understand the companies exposed to that? Is this the Home Depots of this world? Is it a company in the materials business? Where am I getting that exposure?
I think that you wind up actually, again, the easier exposures, the safer at night exposures wind up being the home improvement chains, which can actually benefit from, strong comps. A lot harder to have shrink when you start thinking about it. It's hard to carry a 2x4 out and not get noticed walking out the front door. When we think back to what we've heard over the last several days from retailers, whether it's in the discounters or other large retailers they continue for a year now. We've been talking about shrink this and shrink that. Harder to do with plywood and 2x4s. Now, I think when you start getting into the actual mechanics of what it winds up being sold, you do have issues with respect to supply chains still being unkinked within that. So I'd rather go more with simpler and easier trades where I have to get one thing right. People are fixing their houses rather than trying to guess whether it's paint, whether it's cabinets, whether it's plumbing fixtures. That gets a little bit more granular than my ability to actually make that right call all the time. And so I'd make it simpler and go to home improvement and get the broad theme right rather than having to be specific.
Jack, what you just said on the retailers, too true. I'm thinking of a name right now. I'm looking at Dollar General on the screen, down by more than 16%. Is your message, maybe not just for this name, but names like it, steer clear?
It's not steer clear, but on one hand, I'm not sure why the street is surprised by the Dollar General news this morning after the Dollar Tree news last week, which also reported many of the same themes and saw almost a comparable price decline. And I think you also then think about that and bringing this back to what's an investor's horizon. Because clearly retail has been troubled, and it's been troubled for more than a year now, going back to Target almost a year and a quarter ago when they began talking about having challenges around inventory and having a mismatch versus what the consumer suddenly wanted. And when we now have higher gasoline prices effectively pushing and pressuring that lower end consumer. The flip side, though, is when you think about places like the discounters, the dollar stores in particular, they are more rurally oriented, and we are, as a U.S. government, is dropping $1 trillion on those rural economies, which should ultimately be good for wages, should be good for jobs, and should be good for sales for those retailers left in those markets.
Jack, appreciate the update.
Not everyone can be served by Shopify.
I always do. And I'm going to be thinking of that line about not being able to walk out of Home Depot with all that stuff. Jack Caffrey, thank you, sir. Appreciate it. About 15 minutes into the session, equities up by 0.1%. Coming up, American Airlines flight attendants voting yes on a possible strike.
All of these strikes and wage negotiations are a really important reminder that labor supply is still very constrained. Workers do still have a lot of bargaining power for higher wages.
Team coverage up next.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
DHL is sending a consistent message with its investments. The company spent 123 million euros to upgrade its logistics centre at the Cologne Bonn airport, designing it around key strategic goals.
What I love about this building is it actually shows the big mega trends which formed our strategy 2025, which was inaugurated in 2019 when this building opened. So globalization, connecting the world. E-commerce, we have a lot of sortation facilities here for smaller e-commerce shipments. Sustainability, it's a very sustainable building with solar panels on the roof and everything. and digitalization, and well, you can obviously see that it is quite automated.
How did the team pitch this investment to you initially, and how hard was it as a sell for them? How quickly did you turn around and say, yes, this is worth 123 million euros?
Of course, you always have to make sure that you have the right capacity for the growth in the network. And at that time, they came and said, hey, we will really see a strong growth in e-commerce volumes on top of the regular B2B growth. We need more sorting capacity. We need this building. And of course, there are always debates. Does it really have to cost 123 million euros and so on? But fortunately, they convinced us, because then with COVID and the volume surge, we urgently needed the capacity.
Names in global leadership are on Bloomberg.
When the dust settles, Israel will not only will remain a democracy, it will be even a stronger democracy, but more importantly, it will not in any way impair the enormous business and economic capabilities of Israel in the new technological age.
Nobody covers the top global leaders like Bloomberg Television and Radio, your global business authority.
These strikes and wage negotiations are a really important reminder that labor supply is still very constrained. Workers do still have a lot of bargaining power for higher wages. So even if we saw softer jobs numbers, it could be because of strike effects. It could just be because we are in a tight labor market. We're running out of people to hire. Labor supply is still an issue here.
That was Citi's Veronica Clark weighing in on labour market conditions. American Airlines flight attendants, just the latest group voting yes to trigger a strike. The union writing this: we are long overdue for a new contract. We are ready and willing to do what it takes. Votes tallying over 99%, paving the way for a possible walkout as early as November. Let's get to the team coverage. Bloomberg's George Ferguson with us from Detroit alongside Anne-Marie Hordern in Washington, D.C. George, first to you. We dealt with the pilots. Now we've got to deal with the flight attendants.
Yeah, so that's another agreement that's pre-pandemic as well, right? So it's waited a long time. The attendants look like they initially want a 35% increase, even higher than what the pilots were getting. I tend to think that's a bit too high. I realize that they're not as well paid as the pilots, and they probably want some catch up, but it seems to be a bit too high. It's probably less of an issue for the airlines. I mean, there's the pilots, we think they're about 25-30% of all labor costs. Flight attendants are going to be much less than that. They're probably sub $1 billion at an airline like American. That's probably going to make $2.5 billion this year. So to give them 30% is not going to add a lot to expense, but it's a continuing drumbeat at the airlines, right? There are a lot of unionized workers at the airlines. They all want increases, and it's adding up, right? It builds into the expense base, doesn't get unwound. It creates continued cost challenges.
George, just how understaffed are some of these companies, and have they learned to do a whole lot more with a whole lot less over the last couple of years?
So, I mean, I think it's really hard to do more with less, right? And especially the attendants, because the attendants are regulated by the FAA and the number you have to have on an airplane for it to operate. So you can't operate understaffed, but there's been a fair amount of turnover. And I think the challenge really at the airlines has been rehiring and then getting the training up to the point where they can operate at the efficiency that they were doing in 2019. I don't think they're there yet. They've gotten a lot better. I think turnover has stabilized to some degree, but again, more to go to get them back to 2019 levels of productivity.
Hey, mates, we talked about this a million times. It's like another day, another threat of a strike in America.
Yeah, that's right. It's really a hot labor summer. And what you're seeing is, as the economist pointed out, that you have a tight labor market, and the unions are using this to try to make sure they can get better leverage when it comes to contracts. And when you look at potentially this strike, it wouldn't happen until early November. There's also federal law, Jonathan, that makes it very difficult for airline unions to actually legally strike, and the president and Congress could get involved. But it was almost unanimous. More than 99% of these airline flight attendants voted to authorize this strike. And what you hear from the union is that they say that this is a message to the executives at American Airlines that flight attendants are fired up and they should take this strike authorization at their peril. So what they're really doing is just upping the ante and having that leverage to go into these negotiations.
Cameron Dawson called it hot girl summer. AMH, is that your line? Hot labor summer?
Hot labor summer, that's my line. It's even now an Urban Dictionary because the individual who gave Biden and helped him coin the term that he wanted to be the most pro-labor union president in modern history, he kind of shrugged me off when I said, hey, it's a hot labor summer. And he's like, I don't believe what you're saying. I don't really believe that. But it's true. Look, we potentially might have auto workers striking as soon as September 15th. We still have the writers and the actors striking in California. We just had the UPS Teamsters. We just had the airline pilots. It is a hot labor summer, and it's in the Urban Dictionary.
AMH, there we go. I'll be using that line. I'll be borrowing it and citing you every single time. Anne-Marie, thank you, alongside George Ferguson. About 23 minutes into the session, up here by 0.2% on the S&P with a sector price action. Here's Abby.
So not a lot of drama here for sectors, John. On the day, we are looking at a fifth update for the S&P 500, possibly the longest winning streak since the middle of June. Right now, we have the best sector is communication services, followed by tech and discretionary, but none of them up more than 0.5%. Staples is the worst, down 0.3%. We also have healthcare down there. So the fact that the defensive sectors are down is actually risk on. Now, on the month, it's just so interesting what we're looking at. Most sectors are lower on the month. Energy and healthcare are the two sectors that are higher on the month. And then to the bottom, we have utilities. As you had mentioned the other day, utilities getting absolutely killed. But tech, John, really making a comeback at this point now, down just 1% or so.
Abby, thank you. Your trading diary up next with payrolls just around the corner.
Thing in life I've often said is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
This is Bloomberg.
Five-day winning streak on the S&P. Stocks gaining across the board here. Let's get you to the trading diary. Broadcom earnings coming up after the close. Friday, the main event, it's the payrolls report. We'll hear from the Fed speakers, Bostic, Mester, through the rest of this week. Remember, Monday, US markets are closed for Labor Day. As if you needed a reminder, I'll be away tomorrow. I'll be watching payrolls come in, of course, from wherever I am. I'll catch you after the long weekend. I'll see you Tuesday from New York City. This was the Countdown to the Open. This is Bloomberg.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long skinny necks. So Apatosaurus is an example. They also had really long skinny tails. So I made a computer model that showed that in fact the tail of these sauropod dinosaurs could actually act like a whip, a bullwhip. Now the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. I think the way they got a date was to impress the females by making loud booms.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe the central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Thursday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Coming up, we're going to check in with Anna Wong, Chief U.S. Economist of Bloomberg Economics, get her thoughts on all the eco data we received today and this week. Plus, Mike McGlone, Senior Macro Strategist with Bloomberg Intelligence. We're going to talk commodities with Mike, talk a little corn, maybe throw in some Bitcoin, and if I can, I will get a question in on pork bellies. That's the big mover here today. Greg Taylor, CIO at Purpose Investments. He's going to join us as well to talk about ETF inflows. There's no outflows for ETFs. It's just inflows, it seems. That's where the money is going. We'll check in and get the latest on that market. But first, we're going to kick this hour off with John Tucker.
Yeah, and there's green on the screen. The major stock averages right now, they're all higher. S&P 500, 7 of the 11 major industry groups are in the green. Communication services and consumer discretionary in the lead there, with Alphabet among the individual shares pacing the gains. Then you had Fed Chair Jerome Powell's preferred inflation measure picking up to the highest reading since January. So the thinking is that could keep another Fed rate hike, maybe in November, in play for the time being. As we close out the trading month, John Stolfus, the Chief Investment Officer at Oppenheimer in New York, he remains a stock market bull.
4,900 for the end of the year remains our target. We did lower our projection of what earnings will look like for this year from 230 down to 220. But overall, we're looking for support to the S&P 500.
I just can't cut out the Tom King comments in those.
Why would you? You wouldn't.
It's too difficult. Investors' next focus moves to Friday's jobs report for hints of the strength of the labor market, with particular focus on wages for any hints of inflation there. S&P 500 12 points higher. That's up 0.3% at 45.27. Dow Jones Industrial Average up 110 points. That's up 0.3% right now, and the Nasdaq 100 74 points higher. That's up 0.5%. 2-year yield right now at 4.89. That's relatively unchanged on the morning. There was like a guest who was delivering, in response to an answer, The Secret of Life.
Yes.
Waiting for it to get, and Tom steps on him, so you never really got the secret of life.
But that's
the way it works.
That's the
every
way it works.
morning.
And even though Rich Truman, our intrepid producer, says, "Be quiet, I need this clean tape for John Tucker."
Yeah, doesn't work that way. That is your market update. We check the markets all day long, right here on Bloomberg Radio. Simone and Paul.
All right, John Tucker, thank you so much. We appreciate that. Simone Foxman joining us here. Good morning.
Yes, not Matt Miller.
No,
I've just begun describing myself that way on
exactly,
radio.
Not Matt Miller.
Not Matt Miller.
Presumably will be back next week if he gets in through the border controls. There are signs out there for him, but we'll see if he can get through somehow and make it back into the country. He's over in Spain doing his thing. But it's Simone Foxman, Paul Sweeney here in the Bloomberg Interactive Broker Studio. We're streaming live on YouTube. So head over to youtube.com and search Bloomberg Radio. Nice little start to the market trading here today. S&P up 0.25%. Emily Grafeo joins us. She covers all the markets for Bloomberg News. She joins us here in our Bloomberg Interactive Broker Studio. Emily, what are you looking at today?
Dollar General getting crushed today.
Didn't see that coming.
17%. And it's interesting because we got the macro data about spending staying strong. We have some parts of the market showing that the consumer is strong, but I think it's a little bit more nuanced. We have lower income consumers pulling back. At least for Dollar General, the company cited rising labor costs, effort to tame inventory growth, and they said that the annual earnings will tumble as much as 34% on a per share basis. I think that's what investors are focused on, because they had previously said that measure was only going to fall 8%. Wall Street had been projecting a drop of 6%. So it's getting crushed. It's also one of the worst performing stocks in the S&P 500 year to date, Dollar General.
I felt like the dollar, you think about the consumer, and a lot of the concern was the consumer was spending through the savings that they're spending through. They burned through the stimulus money by and large. Now they're kind of eating to some of the savings. We're seeing credit card debt, personal go up a little bit. So even the dollar stores are seeing it as well.
Yeah, and I actually found this really interesting because, some discounts, some retailers are able to benefit from this. You had TJ Maxx with sort of blowout earnings.
Yep.
But then you had, I don't think Dollar Tree was very strong either. Clearly there's a lot of spending on the consumables. That's always been the biggest share for folks like Dollar General, and that is lower margin. But it just feels like they're not picking up as much of this trade down business as they could. Are consumers trading down at all is kind of a question mark that I'm wondering about.
Dollar General is the largest U.S. retailer by store count.
Wow.
I had no idea.
I would have just guessed a Walmart or something.
Right,
I don't know.
exactly. This is according to a Bloomberg article.
Oh, I'm going with it.
I'm going to go with that.
I'm going to go with it. We care a lot about the what we put in our stories. But Chewy as well, seeing not so great an earnings report. Is this some of the same, Emily?
Yeah, that stock, it's selling off as we continue on with the trading day. It's now down about 12%. It was only down about 5% in the pre-market. They had a downgrade from Evercore ISI. They had a rating on the stock that was an outperform. They've moved that to inline. And this again reflects the disappointing earnings. They had a decline in net ads for Chewy. Chewy's interesting to me. During the pandemic, it was such a success.
Yep.
It was really seen as a competitor finally to Amazon. Amazon, giving consumers all different kinds of products, Chewy specializing in just pet products, and they really found some success there. But now, again, I guess seeing some weekness related to the
my
consumer.
experience with Chewy is in my condo, we have a very angry dog named Harry. He has he's just not a nice little fellow there. He's always growling and jumping and ready to rip you to shreds, but he's a big Chewy guy.
Yeah.
So he gets his Chewy delivery, every couple of
Well,
weeks.
what's interesting about this business model is that the more people they can get to sign up to subscribe to their, auto deliveries, the more money that person sends to Chewy. And overall, the consumer that is already a Chewy customer appears to be buying more, at least from the earnings results.
That's right.
But that there are fewer new customers.
Right.
And I wonder at the size of this market overall generally, because, a lot of people who were ever thinking about getting pets, they got their pet during the pandemic. And they're not there's not a huge upside, perhaps, to the pet market.
I did not get a pet.
You did not get a pet.
No
Number
way.
of active customers, 20.4 million, which was
Are they
in line with estimates.
Are they primarily U.S. Chewy?
I believe so.
I believe so,
My
yeah.
little PGEO. But,
And that was down year over year, 0.5% year over year, but right in line with estimates. I have to say, my parents use Chewy for our pets, and Chewy sends
Pets,
a personalized. Well, we had 2 pets. Now we have 1.
Okay.
But they send a personalized birthday note to your dog, like dear, and then they have the dog's name.
What's your dog's name?
Brother.
Penny.
What is it?
Penny.
Penny. Okay, what kind of mutt is this thing?
A yellow lab.
Nice.
And we had another yellow lab. She's not with us anymore, but they're 2 big Chewy customers.
All right, now we got to go to John Tucker. What's your pet situation here?
Well, the pitches, I'm still grieving. This is like going on 2 years.
Sorry,
I haven't gotten over that
never
yet.
forget.
So that's the sensitive nature. of
It
John
is, right? I
Tucker
still
here.
say, we have 2 dogs, but we do not have 2 dogs.
So, John, are you going to get another one?
Well, for the first time in years, the house is clean. I don't have to be home at an appointed hour, so
Okay.
Yeah.
We'll
See, we were when my husband and I were living abroad, we adopted 2 new pets. We had a cat, we got another cat, and a dog. The dog was our pandemic pet acquisition. But
Now, is that
John? If you change your mind, I know where you can get plenty of lovely.
I don't know.
rescue
It's just
dogs.
like I'm under a great deal of pressure to get a new one, but I'm pulling off.
Emily, talk to us about Apollo Global, the hedge, the
bringing it back to
private
markets
equity
here.
thing. What's going on there?
So I'm looking at Apollo. The stock was down. Now it's up about 1%. We have an S&P 500 index rebalance announcement coming tomorrow.
Nice.
And
That's
there's
big.
been a lot of speculation that Apollo is going to be added. As to how much that is going to boost the stock, we'll have to see. But I'm looking out for that. At least now it's
That's
it's
the thing.
positive.
All right, that's the thing. All right, Emily Gaffreo, thank you so much. We appreciate it. Emily Gaffreo, Penny, the yellow lab, all good stuff there. So we appreciate getting that update. S&P 500 up 0.25%. Let's check in with Anna Wong. She's a chief U.S. economist with Bloomberg Economics. She joins us here. Anna, we had a lot of economic data this morning. What did you take on the inflation picture here in the United States?
Right, and the inflation is still, I think the story of disinflation is still the dominant story. We saw the super core, which is core services excluding housing, surged in July, but that's driven by a very volatile category named financial management, and that's related to the stock rally in July. So I think, but all in all, for the real economy, what matters are the other super core categories, and those are still showing some signs of disinflation. On the other hand, consumption has seen a burst in July, and we traced that burst to the Barbenheimer and Taylor Swift and Beyonce effect. Yes, it's
Wait.
Wow.
Let's come back to that.
explained by that. Yes.
What are we ascribing to Barbie and Oppenheimer?
This burst in consumption in
okay.
July. Yeah, and you know the biggest selling concert last year in North America is by a band called Bad Bunny. I don't know you, but I don't know Bad Bunny, but I do know Taylor Swift and Beyonce, and so together they make for kind of like a Olympic event in July, and that's why we see this unsustainable burst of consumption.
Yeah, that's real personal spending up 0.6% in July. That's the strongest advance since the start of the year. So you're saying, Anna, you said you don't think we'll see another number on this caliber because no Barbenheimer. Well, Taylor Swift's continuing, but I guess people bought tickets already. So we should look for that number to come down from now on?
Well, so Taylor Swift's tour in North America ends after August, and so is Beyonce's tour. So in the fourth quarter, there will be, just think about the fact that you don't even have a super pop star to maintain the same level of spending. That will be an automatic negative monthly growth going into September. And then on top of that, you have the underlying force of consumer balance sheets worsening as they have to pay back student loans, and we're seeing an uptick in delinquencies in credit cards and auto loans. So yeah, I don't think it is sustainable. We likely will be seeing some negative prints in consumption going into the fall.
I wonder if this is a new lever of Fed policy. Have Jay Powell call up Taylor Swift, call up Beyonce, tell them when to schedule their tours to adjust as a new lever of monetary policy.
So, I mean, and I'm guessing at the University of Chicago, where you got your PhD in economics, they didn't give you, there wasn't a class on like T Swift or the concert impact on GDP and inflation.
Studying the Beatles and all that.
Yep.
They do teach us that people are rational, but the fact that consumers are spending money that they don't have seems to me that, in fact, they give too much credit to the median American consumer.
Right. All right, so can we take, Anna, can we take recession talk off the table once and for all here?
Definitely not.
Oh,
If anything,
that's just your model speaking, Anna.
No, if anything, this temporary boom in consumption is actually increasing the possibility that in the next couple of months we are going to see a negative PCE in consumption, and that's one of the indicators that go into the NBER recession dating. And also on top of that, going into the fall, we're going to likely going to have a government shutdown as well as a UAW auto strike, and that could, both of them together could potentially turn the non-farm payroll report for October negative. So there you have it. The two remaining NBER indicators that was in positive territory that kept a recession away, those are turning around likely in the fall.
I want to address another somewhat cynical story that we had out yesterday. Poor Americans tap debt, buy less food as consumer cracks widen. Essentially, this was a survey of people on SNAP assistance programs. So people who with incomes at or below the poverty line, saying 42% skipped meals in August and 55% ate less because they couldn't afford food. That's more than double than last year's shares. Talk to me about how the federal government addresses what seems to be a clear divide between higher income consumers and lower income consumers if they're trying to cool off inflation, but without hurting the bottom half.
Yeah, you're absolutely right, and it's an impossible balance to strike because monetary policy is a very blunt instrument. It does not differentiate between lower income and higher income, and this is why high inflation, running the economy hot in order to boost unemployment and on the lower. That was the motivation for running the economy hot, right? But ultimately, inflation hurts the bottom percentile of the household more than the upper half. So it's just an impossible balance to strike.
All right, so Anna, I'm looking at the WIRP function on the Bloomberg terminal, the interest rate forecast. Lots of rate cuts kind of is what the market's suggesting for 2024, yet it's been hugely wrong for a long time, kind of what the market's looking for. What do you think the Fed's going to do in 2024?
Yeah, I actually thought that what the market priced in so far, about 100 bips of rate cuts, is reasonable by our model because so I think that's a reasonable thing to price in.
Yeah, I wonder, the Fed says, well, Jay Powell says, don't think about cuts. And yet it seems like the market's certainly pricing in, looks like four cuts by the December meeting next year. Really quickly, we only have about 30 seconds here. What are you looking for from the all-important jobs report tomorrow?
We're expecting 185 6K change in non-farm payroll and an unemployment rate of 3.5%.
You're not going to get a recession with 3.5% unemployment, Anna. So I'm just telling you right now, I know you've got a PhD in economics from the University of Chicago, an undergraduate degree in economics and statistics from this little place called Berkeley. I took 2 economics classes at business school, so I think I know what I'm talking about here, despite your PhD. But we'll see how it plays out. I'm in the no recession camp, and Anna Wong is so much better than this, than the rest of us and all this stuff. We appreciate getting some time there. Anna Wong, chief U.S. economist for Bloomberg Economics, checking in with us here on the back. Some pretty solid economic news. There's inflation out there. It's coming down. But it's probably maybe a little bit more sticky than some people would like. But clearly, the Federal Reserve paying clear attention to that. That is job one for this Federal Reserve. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
You got it, Paul. Offering everyday low prices on popular brands may not be enough for Dollar General. Shares of the retail chain, they are falling. They're down about 16% right now after the company cut its net sales and profit forecast. Now, Dollar General pointed to higher interest expense in fiscal 2023 and said that it will focus on unloading inventory and also investing in retail labor. Shares of Chewy, they're lower after Evercore downgraded the pet company's stock to inline from outperform. Bloomberg's Abigail Doolittle has more.
Evercore ISI in particular would prefer a more compelling valuation level, which is a way of saying that the stock is too expensive for the numbers that they're putting up. Morgan Stanley has kept their equal weight rating, saying that the negative net adds in the second quarter were offset by better than expected profitability, but the net adds have continued to disappoint.
Right now, shares of Chewy are down nearly 11%. And shares of Campbell Soup Company, they are on the rise. They're up about 0.5% after it reported fiscal fourth quarter profit that matched expectations and sales that topped. Now, this as the company raised the prices of its meals, beverages, and also those snacks. And JCPenney is trying to spark some life back into its business. The Associated Press reports the struggling retailer says it plans to spend more than $1 billion by the end of 2025 to remodel its stores and make online upgrades. Now, some of those upgrades include better lighting, improved Wi-Fi, and a fresh coat of paint at the stores, as well as some new tech for workers and checkout stations being replaced with single-area cashiers. Those are the company stories we're following this hour. We'll have more in just a bit. I'm Lisa Mateo, and this is Bloomberg.
Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Green on the screen. 6 of the 11 major industry groups in the S&P 500 higher right now. Consumer discretionary leading the gains. That's where you'll find shares of Amazon. Fed Chair Jerome Powell's preferred inflation measure. Core services, excluding housing, picked up to 0.46%, 4.6% month over month, 0.46% month over month. So that's the highest reading since January. And the bottom line, it could keep another Fed rate hike in play, especially for November. Investor attention turns to tomorrow, the jobs report. That's going to provide further insights into the direction of the labor market and some of the individual shares on the move. Of course, AMC Entertainment shares higher. They say they're going to play Taylor Swift's new film at least 4 times a day. S&P 500, I couldn't tell you a single Taylor Swift song.
What? Not surprising. I'm just going to go there. Not surprising.
Sorry. S&P 500 up 15. Dow Jones Industrial Average up 105 points. The NASDAQ 100, 94 points higher. 2-year yield right now, 488.
John,
check the markets for you. I'm not even going to answer. I shouldn't have said that.
You're my anti-hero. How's that? This millennium. No, I could sing some of the songs, but I'm not going to.
Oh yeah, we could do that. We could do that. All right.
Wants to hear that.
Very much all right, John Tucker. I don't know where to go with that, but John Tucker, he's our news guy. He's not our Swiftie guy. He's our news guy. He's our congestion guy, but just not a Taylor Swift person. Simone Foxman, Paul Sweeney here in the Bloomberg Interactive Brokers studio here. We're streaming live on YouTube, so head over to youtube.com and search Bloomberg Radio. All right, Chicago Board of Trade corn prices this year down 32%. What is up with that? I'm eating as much corn as I ever have. I don't know what's going on with the price of corn. I guess it's more supply than demand because it's a commodity. But let's check in with somebody who does this stuff for a living. Literally, Mike McGlone, senior macro strategist for Bloomberg Intelligence. Mike, I like corn as much as the next person. Why is the price of corn down 32%?
Well, hey, Paul, as the farmers say, it's the higher price cure. That's the bottom line. Corn had a big pump last year on the back of Russia's invasion of Ukraine. And what does that typically do? It incentivizes plenty more supply, and we're seeing it globally. The U.S. is catching up a little bit. This should be a very good crop this year, near the highest production ever. And most notably, what had the most time to pick up was the massive supply of corn and soybeans out of Brazil. And they just do what they've been doing for the last almost 20 years. They just amp their production. And when farmers can make profits, they always create a lot of supply. And that's the key thing to remember about corn, soybeans, and wheat is they virtually never stay up because farmers can make more money when they'll plant when they can make money like they did last year.
You're right, because soybeans are down 10% year to date, and wheat is down 28% year to date.
Yeah.
Yeah. So America has held the top spot in terms of corn exports for years. But now Brazil may be challenging it. What's the dynamic there? And does this increased competition, is that going to weigh on the price of corn for the foreseeable future?
Absolutely. It's the price of corn is heading towards $4 a bushel. Right now, it's just above, just below 5. And it first traded that price in 1974. That was on the Great Grain Robbery when Russia imported the then Soviet Union imported a whole bunch of grain. But what you pointed out, Simone, our body's in motion. Brazil's production has been increasing rapidly for at least the last 10 years. If you just look at charts going back to beginning 2000, and it's still heading that way. But what happened with this war, which we pointed out right away, just created more and more incentive to produce more corn. But also there's been a paradigm shift in the U.S. The U.S. now uses almost 40% of the crop for ethanol. But the unique thing about that is, that's for motor vehicles, for gasoline. The unique thing about that is it's just going back the way we were before. In 1920, before the automobile became proliferated, a lot of the grains that were grown in this country, oats and hay, were for feeding horses. Now some of it feeds cars. So, but that's the key thing to remember about corn. In most agriculture countries, most countries in the world subsidize their agriculture production, and we're getting to the point now where farmers may be able to be subsistent without a lot of these extra programs from the government. A lot of it's because we use it for clean fuel, for ethanol.
Mike,
so interesting.
I know it's all intertwined. How hard or how easy is it to grow corn?
So corn it's difficult. It's the most fertilizer intensive crop, and as we mentioned in an earlier segment, a lot of farmers will say out in Illinois, where I'm from, they'll grow beans so they can plant corn the next year. But it's the most intensive for you need a lot of anhydrous ammonia, which is the base for that is natural gas, which has plunged this year, which means cost of production is going down. But it's harder to grow. Beans are much easier. You don't really need a lot of fertilizer. But when you work them in rotation, they all work out better together.
Well, and it's interesting, you were mentioning the impact of the Russian invasion of Ukraine before, but fertilizer is a place also that is so incredibly dependent on China and Russia. And what it sounds like you're saying here is not that our desire for corn is or the global demand is falling anyway. It's simply that the U.S. is eating up more of the overall share for itself for non-eating purposes. Does this add to the, I guess, do these shifts add to some of those sustainability concerns as the United States is increasingly dependent on corn for like transportation issues as well?
Not at all. We can grow more. We still have about 10% of our entire land in what's called the CRP, the Conservation Reserve Program. I used to have my farm in that for a little while. And it's where the government pays you to not farm. So obviously you're not going to put your best form there, but that's the key thing about, let's just point out the facts of deflationary forces in corn. The average acre of corn planted this year will probably produce about 175 bushels per acre. Just 50 years ago, it was half that. So that's just what's happening with rapidly advancing technology, new seed technology, new planting techniques. Is we can just create more with less every day. That's normally what happens with commodities. And corn is the most significant agriculture crop on the planet. And the U.S. has been the epicenter, but don't worry about us creating more. And even if we have a severe drought, there's a lot of different time zones. There's irrigation, and there's plenty of production coming out from south of the border, from Brazil. So, I look at it as I always like to point out when people get bullish, when markets go up, grains are the #1 commodity you never want to buy after they go up. It's a higher price cure. And here's the neat thing about ethanol is we are now rapidly going to EVs. Total consumption of unleaded gas in this country is still about 5% below where it was before COVID. And now we're switching EVs so fast. Total sales of automobiles in the world now are almost 15% EVs. All that was accelerated by the war. And that means a lot of the demand source for corn might be going away.
And I should note, I'm looking at our chart of corn prices. We're back really to levels where we were in mid-2021, October 2021, it looks like. So as you said, be cautious about getting into commodities after spike.
Mike, the McGlone family used to own a farm in Indiana. How many farmers are there like the McGlones out there? Like, give us a sense of what's the farm economy in the U.S. now versus like family-owned farms versus, I guess, corporate farms?
Going much more corporate. So it was always a gentleman's farm. My grandfather bought it during the Great Depression, and he always cash rented it. That's a term you use. You own the land and just let other people farm, and they'll pay you a cash rent for that. Now, I know a few big producers out in Champaign, Illinois, which is some of the best ground in the planet, and they own the land, they manage it, and they just have farmers do it. So it's becoming much more corporate, but it's so efficient. It's just incredibly efficient. The key quote I get every time I get out there is the technology is so hard to keep up with. For instance, there's this thing called Exact Shot from John Deere, where they can now, when they plant that seed, give it the exact amount of fertilizer where it needs, where they want it, and it can reduce fertilizer costs by 60%. So it's just that rapidly advancing technology in that area. It's hard to keep up. The weather is still unpredictable, but we now have, with hybrid seeds and things like that, you can do pretty well with, for instance, here's a good example. When I was a kid, the average corn stalk had 1 ear. Now you have 2 or so on per corn stalk. My question is, what stops that from going to 6 ears per corn stalk? It's just the trend's your friend for production, but not for prices.
Wow. All right, let's switch gears here. I could talk, and we'll get to pork bellies at some point, but let's turn to gold here. Are we still just long gold and kind of short everything else?
I look at gold as the most likely asset and commodity to continue advancing. Now, that's not so profound because it typically outperforms most commodities over time, most notably copper, most notably crude oil. But the average price this year is $1,933. I love saying that, Paul, because that was a significant year where Franklin Delano Roosevelt debased the dollar versus gold, and that bottomed all the deflationary forces. It bottomed the stock market, and it bottomed deflation. But I look at gold, that's the highest average price ever. 1933. I see it as a bull market that's just waiting to break out. The key triggers would be some form of Fed pivot. As you mentioned in the earlier segment, the WIRP function is tilting that way. And I think the key thing to get that Fed pivot is probably a stock market decline. But to me, gold is, and I just showed on the year, it's up 6% on a 12-month basis. It's up 10%. Virtually every other commodity is down. Here's the question. What stops that trajectory? I suspect it's more likely to accelerate. And as you heard Anna Wong in the previous segment point about recession, here's one thing I point out about gold is there's a 100% probability when unemployment rallies from this level, when it goes higher, that we'll have a recession, because that's the way it's always worked. And that to me is what's going to trigger gold. So my theme this month, as I'm probably my commodity outlook, is gold has been outperforming all other commodities. What stops it versus I'm fearful it's going to accelerate.
All right, Mike, always great segment. Always appreciate getting your color there. Mike McGlone, senior macro strategist for Bloomberg Intelligence, ensconced down in Miami Beach. Right now, let's go to Amy Marr. She's in Washington, D.C., and she's got world and national news.
All right, thank you, Paul. Hurricane Idalia smashed into Florida's Big Bend as a Category 3 hurricane yesterday. She's still dumping heavy rain on the deep south. Florida Governor Ron DeSantis says some of the worst effects are in a lightly populated part of the state.
We clearly have significant damage throughout the Big Bend region, but the response has been swift and people are getting help.
Idalia led to more than 1,000 canceled flights and left about 325,000 people without power from Florida into the Carolinas, and is expected to cause $10 to $20 billion in damage. Growing concern about Senate Republican leader Mitch McConnell's health after he froze when a reporter asked his thoughts about seeking re-election. The senator abruptly stopped and stared for about 30 seconds, and then his aides intervened.
All right, I'm sorry, you all. We're going to need a minute. Senator.
A spokesman for McConnell said in an emailed statement that the senator felt lightheaded during the press conference. An aide said he felt fine but would be consulting a doctor. President Biden planned to reach out to McConnell after the incident.
Mitch is a friend, as you know, not a joke. We always know people don't believe that the case, but we have disagreements politically, but he's a good friend, and so I'm going to try to get in touch with him later this afternoon. I don't know enough to know.
There are concerns about the 81-year-old Republican's health. Yale University President Peter Salovey is stepping down after 11 years. The 65-year-old says he's ready to return to a teaching role in the university's psychology department. He's leaving the post in June. The Food and Drug Administration sending warning letters to several infant formula manufacturers. The agency says its inspectors found safety violations at ByHeart, Mead Johnson Nutrition in Perigo, Wisconsin, including finished formula that actually tested positive for Chronobacter. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Amy Morris, and this is Bloomberg.
facts, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Stocks are higher. Treasury yields slightly lower. Amazon, Apple, Meta, and Broadcom pacing the gains. As Salesforce shares, they're also rising up about 4.6%. The software company reporting second quarter results that beat expectations. They also delivered an outlook that is seen as strong. Fresh batch of data on inflation and consumer spending. The Federal Reserve's preferred measure of inflation edged higher in July, accompanied by a burst of consumer spending. Still, Hugh Gimber at JP Morgan Chase says the near-term path ahead for the Federal Reserve is now set.
It feels like their September decision to pause and wait to see how the data falls out now is probably relatively well set. But then you roll into the November meeting, and they're going to need to see a further slowing in the economy to allow them to feel comfortable that now is a good time to pause.
The S&P 500 right now 16 points higher, up 0.4%, 45.31 on the index. The Dow up 116 points. That's right at 35,000. And the Nasdaq 100, 109 points higher. That is up 0.7%. So who says the economic data can't be fun?
Yeah.
I'm trying to actually parse this. So we talked to Anna Wong. We have the PCE. Let me get this straight. So Supercore is what we're calling it. That strips out the data that we get on housing. And Anna Wong was saying in Supercore, that today, the numbers there all reflected a rise in investment fees. So now you have to strip that out, and Cameron Price is calling that the super duper core.
Of course he would, because he's a Duke guy.
Well, but when you strip all these things out, though,
what are you
I mean, this is the stuff that also the stuff that consumers react to. I don't know.
If it's not on my eco screen, I'm not quoting it.
Okay.
ECO. Tom from the fifth floor decided that which data point should be on ECO.
I want super duper core on my eco screen.
All right, we'll see. We'll talk to Cameron Price on that. All right, John Tucker, thank you so much. We appreciate it. Simone Foxman, Paul Sweeney here in the Bloomberg Interactive Broker Studio. We're streaming live on YouTube, so head over to youtube.com and search Bloomberg Radio. Let's talk ETFs. And usually I want to talk about flows, where the money's going, and all that kind of stuff. But I want to do it in the context, I'll start off at least, by talking about Bitcoin ETFs, because our next guest, has some experience in that. Greg Taylor, CIO of Purpose Investments up there in Canada. So, Greg, I guess in the ETF biz, at least here in the U.S., a lot of talk this week has been, hey, maybe we're going to get a Bitcoin spot ETF. You guys already have that in Canada, don't you? Can you tell us a little bit about the Bitcoin ETF?
Yeah, for sure. And thanks for having us on. In Canada, we like to think that we're one of the first innovators in the ETF space. A lot of the first in the ETFs globally have happened in Canada. And one of those of late has been the first spot, the Bitcoin ETF, which we launched at Purpose in February of 2021. And I think it's great to hear that the U.S. is finally catching up and going to launch one as well, because really when you look at any type of ETF in a commodity world, you do want to have spot versus futures. And I think spot ETF is something that would be welcome to the crypto space, and the experience we've had with it has been very positive. And since we launched our fund in February 21, it's gotten over $1 billion of assets. It's one of the most heavily traded in the TSX, and I think it's been a really good experience for a lot of investors and a good way to get access to the crypto market in a more regulated environment.
So based upon your experience with a spot Bitcoin ETF, what do you think has been, or the SEC or the U.S. regulators have kind of misjudged about a futures versus a spot ETF?
Well, I think when you go between a futures and a spot, I think there's no real argument that a spot one is way better. And when we set up to launch our ETF, we weren't really inventing the wheel. What we did is we really kind of copied or mimicked the way other commodity ETFs have done. Basically, the GLD is a widely traveled ETF in the U.S. on spot gold. And I think it's looking at, when you look at a spot versus a futures, there's always better, because the futures is always going to lose basis points on the roll. So it was curious why the SEC would approve a futures-based ETF versus a spot, because at the end of the day, the futures are going to have to be backed by something. So there is a way to get back in the system, but having a futures-based ETF isn't really good for anyone or the system.
Now, we saw the price of Bitcoin pop after the decision came down in this case. I think there was a lot of enthusiasm. Hey, all these people are going to pile into an ETF rather than try and go out and buy Bitcoin themselves. That said, there's a JP Morgan strategist talking about how, if you have a launch, say, of one of these Bitcoin ETFs, it's not really going to change the overall market enthusiasm for this. It's just going to draw liquidity away from other products. Is this a zero-sum game to you?
I don't think it is yet, because I still think crypto is a commodity that's still really in the early innings of its growth, and I think having a spot ETF, which is one of the best ways to get access to it, is only going to bring on more investors. Currently, if you want to get exposure to crypto the traditional way, it's really not the easiest system. You have to open a separate account with the crypto provider. You have to figure out if you're doing a cold or hot wallet. And a lot of people just don't want to do that. So they want to wait for an ETF that's going to be easy and can track the index. And further to that, I think a lot of people are looking again at real assets. With the amount of money printing going on in central banks, there has been a case to add more of your portfolio towards real assets, and certainly the commodities and gold and real estate are benefiting from this. But I think there's also a way to get that crypto into that bucket of real assets. So I think there's demand for real assets, there's demand for crypto, and people want an easy way to do that. And I think having a spot ETF is one of the simplest ways to get access to it. So I don't think it's a zero-sum game. I think once the U.S. does get a spot ETF, I think that will open up more buyers and sellers, and that's probably why the commodity reacted so well to hints that it does seem like the U.S. getting closer to approving this.
Hey, Greg, let's step back and take a look at the ETF space in general. Give us just an overview. Is the money continuing to gush into ETFs? Just give us a sense of how this year's been.
Yeah, we've had net positive flows this year. ETFs have definitely been a way that a lot of people are getting access to it. One of the big spots for this, for us, and I think for the whole ecosystem in ETFs in the last few months, has been really looking at the money market ETFs. Certainly, money market has become a hot topic of late, and with yields for cash in the 5 to 6%, I think that's been an area that people are trying to get access to, and I think that's where a lot of the gains for the whole sector have been. But I think over time, people are looking for access and simple ways to get it. And in a low-fee environment, I think ETFs are one of those ways to get access to it.
Greg, we've been hearing from some investment strategists pointing to sort of defensive sectors and away from like the tech-driven hype that we've seen over the past couple of months. Are we seeing places like healthcare and places like energy reflected in some of the ETF flows, and will we see more of that as we head towards the end of the year?
Well, I think that's certainly the hope. And being a Canadian, we're definitely, with our indices, tilted more towards the cyclicals and the resource sector. I think we'd love to see that rotation away from technology towards the commodity sectors. And we are starting to see that. Certainly, the last few years has been really good for the commodity growth as we've seen both energy and base metals do quite well. And I think that's really setting up quite nicely for the second half of the year. There's a lot of rumblings about China launching another stimulus program into September. And as the world starts to talk more about a soft landing, more stimulus from China, that's setting up for a decent move in the commodities. And I think that could cause more rotation away from these tech stocks, which have really driven the indices higher to start the year. And maybe some of that money flows back to the cyclicals, which are setting up quite nicely from a supply-demand economics. There's not a lot of supply for new mines and new oil wells coming on. So it does feel like the second half of the year could belong to more of the cyclicals than the tech stocks.
Hey, Greg, thanks so much for joining us. Really appreciate getting your thoughts. Greg Taylor, CIO at Purpose Investments, checking in with us, giving us the latest on the ETF space. Just continues to see amazing funds flow into the ETF space. Makes you wonder about the future of the mutual fund business, which we all grew up with. Now it's really, I think, in large part due to the cost differential. ETFs are a way to go for a lot of folks.
Yeah, places like Betterment, et cetera, make
Yep.
this easy.
Yeah, exactly. And it's interesting. I think what I understand is from, tax-free accounts, still a place for mutual funds, but otherwise ETFs and the cost structure and the reporting and all that type of stuff seems to be a better wrapper. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
You got it, Paul. Flight attendants and pilots plan to walk out at airports nationwide just ahead of the busy Labor Day weekend. The Southwest Airlines Pilots Association is holding a nationwide picket today over contract negotiations, while United Airlines flight attendants are picketing for a national day of action. Bloomberg's Kimberly Adams says that's not all.
American Airlines flight attendants gave their union leaders the okay to call a strike if the labor group is allowed to end contract negotiations under federal law. The strike authorization was approved by 99% of flight attendants voting. Members began picketing at Dallas-Fort Worth Airport, the carrier's hometown, and other airports around the nation.
And we have shares of American Airlines right now up just a fraction. Same for Southwest right now. United Airlines shares up about 0.5%. UBS Bank has posted the biggest ever quarterly profit for a bank in the second quarter. The $29 billion gain is a result of its emergency takeover of Credit Suisse. UBS CEO Sergio Armodi tells Bloomberg job cuts are next.
We will have around 3,000 jobs that will be made redundant over the next years. 1,000 are in relation to our decision to integrate the Swiss bank.
Now you can hear the full conversation on the Bloomberg Talks podcast. Download it wherever you get your podcasts. Shares of UBS right now, they're up about 5%. And layoffs could be coming to Barstool Sports. The New York Post says the company plans to cut staff by nearly 25% or 100 jobs. It's looking to reduce costs after breaking up with Penn Entertainment. Those are the company stories we're following this hour. I'm Lisa Mateo, and this is Bloomberg.